So hello all my dearest students of South India. I hope you all are doing good. I hope your studies are going on great. So finally the day has come for which you all have been waiting since long, and that is our master compilation, super compilation, whatever name you want to give, of past RTPs of institute, past mock test paper of institute and past exam paper of institute in around 4 to 5 hours. We will try to complete all of them. Around 24 papers we are going to revise in around 4 to 5 hours. That is something which is unimaginable for a student to revise themselves. So without wasting any further time, today we are going to first of all start with our RTP compilation, and that too in full English, especially for my dearest students from South India. Okay. So now we are starting with RTP November 2020, and the very first question over here is on PGPP. The very first question generally in the examination is of PGPP only. It is of total income, computation of total income along with tax liability sometimes. Okay. So let us start with this question. This question is about manufacturing of footwear business and leather product. Very important. Whenever there is a manufacturing of footwear and leather business, you have to be very careful that there can be some implication of 80JJAA. 80JJAA, do you remember? You have to employ the employee for at least 240 days. But in case of apparel business, footwear business and leather business, even if you employ for 150 days, that is much more than enough. So this is what the catch is all about in this question. Okay. So you have to be very careful with this particular point. Now the net profit of the assessee is 544 lakh. This is the first thing that you are going to write. The first adjustment is the accounts depreciation as per company law. So you will add that back. Okay. Second adjustment is about you are about to pay some 64 lakhs to your creditor, but the creditor has waived off 12 lakh rupees and he has told you to pay only 52 lakh rupees. So now if the amount is waived off by the creditor, that is your income, and therefore you have to add it to your P&L account, but this is already credited to the P&L, so you don't have to do anything with this particular adjustment. This particular adjustment don't do any effect because it is already credited to the P&L. Okay. Next one, employer contribution of 6 lakh rupees. Employer contribution you can pay up to the due date of filing of return, and employee contribution you have to pay by 15th of the following month. So this is employer contribution and you are paying before the due date of filing of return, therefore it is allowed. Since it is already debited to the P&L, you don't have to do anything with respect to this. Okay. The next one is an intelligent adjustment. You have taken a loan of 50 lakh rupees for buying some machinery. Now you have taken a loan of 50 lakh rupees at 12%. Therefore the interest for the entire year will come to 6 lakh rupees. Okay. Now, but the machinery is put to use. You have to come to the next line. The machinery is put to use on 1st of November. Therefore, from 1st April to 31st October, whatever is the interest that will come to, that is the interest of 7 months, will be capitalized to the cost of the machinery. Okay. So therefore, the total interest of the entire year is 6 lakhs, and therefore the 7-month interest will be what? First of all, what is the multiple effect of this 7 lakh interest, of this interest of 3.5 lakhs? First of all, this interest of 3.5 lakhs is not allowed as an expense. It will be added to the PGPP income. Secondly, you will claim 15% depreciation, 50% of that because it is put to use for less than 180 days. And then you will compute 10% additional depreciation also because the assessee is engaged in what? Manufacturing. Okay. So you be very careful with this adjustment. It's a beautiful adjustment. Let's go ahead with the next one. You are making some payment to some contractor without deduction of TDS of 20 lakh rupees. So 30% will be disallowed if you make the payment to resident and do not deduct the TDS. Okay. Next one. You are making some fair estimate for periodical wage revision of your workers' wages. Okay. You are making fair estimate. So fair estimate you are making in every 3 years, you make some fair estimate revision in wages and you pay that to the employee. Okay. Because it is a fair estimate, it should be allowed as a deduction. Now this is not debited to the P&L. Because it is not debited to the P&L, it is allowed. So you have to reduce it from the P&L. Okay. Now coming to some additional adjustment. First one, what is the depreciation on building? On building, you will get 10% depreciation. What is the depreciation on plant and machinery? Now be very careful with plant and machinery. It is 340 lakhs total value. Out of 60 lakhs is the new machinery. So for new machinery, we will compute separately. Therefore, how much is the old machinery? Out of 340, old machinery is 280 lakhs. On 280 lakhs, you will get a depreciation of 15% completely. Now, on the new machinery, because it is put to use in November, 60 lakhs is the cost plus 3.5 lakhs rupees. You have to add back what? You have to add back in the form of pre-acquisition interest, pre-usage interest. So 63.5 lakhs will become the cost of the asset. On that, because it is put to use for less than 180 days, you will get 7.5% depreciation normal and 10% additional depreciation. I hope it is clear to all of you. Okay. Now next one, 80JJAA. Be very careful. 80JJAA, apparel business, footwear business, leather business, 150 days is also sufficient. Okay. This is what the ICI is playing with you. Now 24 additional employees are hired by the company. Okay. Now out of which 12 employees were joined on 1st June 2023 at 23,000 rupees. Okay. So will they be eligible for 80JJAA? Yes, they will be eligible. But at the end, it is written that out of that, 2 employees were paid by bearer check. Now, because they are paid by bearer check, those bearer check employees will not be covered over here. Okay. So only 10 employees out of 12, because you cannot make the payment by bearer check. In case of an existing company, you have to make the payment by 4 modes only: account pay check, account pay draft, ECS, and such other electronic mode. You cannot make the payment by bearer check. Therefore, this 10 lakh rupees, this 10 employees into 10 months from June to December, from June to March into 23,000 plus 4 employees were joined on 1st July at a salary of 25,500. Not allowed. If the emoluments per month is more than 25,000 rupees, you are not eligible for deduction under 80JJAA. So this employee is not allowed. Next, 1st November 2023, you have employed 8 employees. Now this is allowed because from 1st November to 31st March, it amounts to around 152 days. And for apparel business, leather business, 150 days is also sufficient. Therefore, these 8 employees are also eligible for what? Deduction under 80JJAA. So 8 into 5 into 20,000 plus the earlier one multiplied by 30% will come to 9,30,000. That will be the amount of deduction that you are going to get it. Okay. One last adjustment. Employee contribution of 3 lakh was paid in July. Was paid in what? July. Will that be allowed? The answer is no. It is not allowed because employee contribution has to be paid by 15th of the following month. If you pay in the month of July, it is not allowed. Employer contribution you can pay up to the due date of filing of return. Employee contribution you cannot pay. Therefore, this will be disallowed. Now, this will be computing your total income. After that, you compute the tax liability. How much tax? You have to ignore the MAT provision. You have to ignore the alternative tax regime. You have to compute as per the normal provision. Therefore, the turnover of last year is less than 400 crore, is up to 400 crore. Therefore, the tax rate will be 25%. 25% tax surcharge will be imposed because the income is greater than what? Greater than 1 crore. So, 25% tax will be imposed. 7% surcharge because the income is greater than 1 crore and up to 10 crore, and 4% cess will be imposed, and then you have to compute the tax. Okay, this is how you are going to go about with this particular question. Let's move on to question number 2 now. This is a question on exit tax. There was a charitable trust which got merged into a business, that is manufacturing business. You have to compute accredited income, and on that 34.944% tax you have to pay. What is accredited income? All assets minus all liabilities. Let us see all assets list by list. First of all, the land will be valued as per stamp duty value or market value, whichever is higher. So here higher value is market value. Therefore, land will be valued at 34 lakhs. Equity shares which are listed in stock market will be valued as per average price on the specified date. On whichever date it got merged, on that date, what is the average price? Average price is 160. So 160 into 75,000 equity shares for listed share. For unlisted share, preference shares, you have to take market value, not book value. So for unlisted shares, I am taking the market value as per rule 17 CB. Corpus fund liabilities, you do not take corpus fund in the liabilities. Okay, you take outside liabilities, you do not take provision for tax in the liabilities, and you take other liabilities for utility bills like outstanding expenses, etc. All these things, add all assets, add less all liabilities. Whatever amount will come will be accredited income into 34.944% will become your what? Will become your taxable amount. Okay, that will be the tax you have to pay as an exit tax. Next question. There was an assessee who is 60 years old and resident, an ordinary resident, and he has an apartment in Sharjah. He also has a bank in Sharjah. Now he is claiming that my total income is less than the basic exemption limit. Therefore, I am not liable to file return. Wrong, wrong, wrong. If you are an ordinary resident and if you have any asset located outside India, if you are a beneficial owner or beneficiary of any asset located outside India, including financial interest in any entity located outside India, then you are liable to file what? Then you are liable to file income tax return irrespective of your income. Then your income will not be seen. Don't worry about it. Okay. In that case, if you have a foreign asset or foreign bank account, you have to file the income tax return. Next question, question number 4. The assessee has filed the return. The assessment is also done, and the AO made 2 additions. One addition he made under section 69 unexplained investment, and second addition he made for a remuneration and interest paid to partners under 40B. Now the assessee challenged the first one, and the assessee challenged the first one. It went to appeal and the appeal was decided. Now the assessee approaches you what it should do for the second one. First one is closed. What it should do for the second one? Can it go for revision under 264 or can it go for rectification under 154? Be very careful. It is not possible to go for revision because under 264 it is written doctrine of complete merger. If a matter is already decided by a commissioner in an appeal, that matter cannot be touched for revision under 264. But yes, rectification under 154 is possible if there is a mistake apparent from record, because under 154 rectification of mistake, it is written that there has to be a doctrine of partial merger. Partial merger means a matter which is merged with a matter which is already decided, that will not be touched, but the other matter can definitely be touched. Therefore 154 is possible because there is doctrine of partial merger. 264 is not possible in this case. It was also held by the court in this particular case. Issue number 5 is also based on one case law. Do you remember there was one section by the name called as 292BB? That is, if the department send you a late notice or an improper notice, then if you cooperate in the department, don't challenge. If you cooperate with the department, then it is deemed to be a valid notice. If you want to challenge before the passing of the assessment order. If you challenge before the passing of the assessment order about the validity of the notice, about the properness of the notice, then the assessment is void ab initio. But the department has not sent the notice only. The department failed to send the notice. Can department cure this defect? The Supreme Court held in the case of Lakshman Das Khandelwal that failure to send a notice cannot be cured under 292BB. If the department did not send a notice only, if the department is sending an improper notice or a late notice, then 292BB can help the department. But if the department does not send the notice, then 292BB cannot help the department under any circumstance. And one last question of the first RTP that is we are doing over here. That is, this question is on transfer pricing. We need to identify whether transfer pricing will be applicable in these three circumstances or not. The first case, always remember, for applying transfer pricing, there has to be two entities, out of which one has to be non-resident, one has to be resident, or both can be non-resident. At least one party has to be non-resident. Secondly, both of them should be associate enterprise. And thirdly, there has to be a transaction between both of them in the nature of various ways, purchase, sale, royalty, etc., whatever it is. Now, the very first transaction is one entity is Indian company, one entity is foreign company. That is okay. Now, one entity is giving a guarantee of 12% borrowing of the other entity. Are they associate enterprise? And the answer is yes. If one entity guarantees at least 10% of the borrowing of the other entity, then both of them are deemed to be associate enterprise. Now, one is NR, one is non-resident, one is resident. Therefore, it is an international transaction and therefore transfer pricing is applicable in this case. Second case, there is a domestic transfer pricing applicable. Both of them, there are two units. One is delta, one is fee. But one of the unit is engaged in development of highway project, which is covered in ATIA, and another unit is not covered in ATIA. Therefore, one unit is covered under ATIA, one unit is not covered in ATIA, and it is providing some transfer of transfer of wires, etc., steel, etc., of 30,000 per metric ton to another entity. Okay. Therefore, if you multiply this, the value of this will exceed 20 crore rupees, and it is that domestic transfer pricing. Remember, when domestic transfer pricing is applicable, when one unit is eligible for what? ATIA, ATIB, ATIC, etc., and another unit is not eligible, and both of them do transactions between them, and the value of the transaction is greater than 20 crore rupees, then transfer pricing of domestic nature is applicable, yet it is applicable. And the last case over here is, there is a holding subsidiary relationship. Holding subsidiary companies are always associate enterprise, and one entity is resident, one entity is non-resident, and one entity is purchasing some machinery from another entity. Therefore, this should also be at arm's length price. Transfer pricing will be applicable in this case also. So this is your first RTP. So let's move on to the next RTP, that is RTP May 2021. The very first question over here is on non-resident taxation 115A. There is a foreign company, Lords INC, who is earning some income by way of fees for technical service of 3.2 crore from an Indian company, Yamuna Limited. And this company has an agreement with Yamuna Limited, and it is also approved by central government. It is very important that if you want to get covered in 115A or 44DA, there has to be an agreement between both of them, and that agreement should be approved by the central government. Very, very, very important over here. Now, they have incurred some expenses of 28 lakh rupees. Now, they have asked us question in two parts. First part, assume that Lords INC does not have a PE in India, and also we need to say whether Lords INC is required to file the income tax return or not. For remember that if a non-resident or foreign company does not have a PE in India, then section 115A will apply, and in 115A the tax rate will be 20%. Or DTAA rates, whichever is lower. Here DTAA rates are not mentioned, so we will take 20%. Okay, so 20% tax will be imposed plus 2% surcharge for foreign company because the income is greater than 1 crore rupees and up to 10 crore. Therefore, 2% surcharge and 4% cess. Okay, now there is not going to be any deduction of expense. This expense is not allowed under 115A. No deduction of PGBP and no deduction of any PGBP or IFOS expenses are allowed under 115A. Okay, now what about the filing of return? If the assessee only earns this income in India, and the TDS is deducted at 20% plus 2% cess, 2% surcharge and 4% cess, then no need to file the income tax return. Okay, but if the TDS is deducted at a rate lower than 20%, that is if the TDS is deducted as per DTAA, then the assessee has to file the income tax return. Here there is no mention about DTAA, therefore the TDS would be deducted on what? 20% plus 2% plus 4%. If the TDS is deducted as per 115A, no need to file what? Income tax return. The second part, the assessee has a P in India and income is connected to this P. So now the assessee will maintain proper books of accounts, will conduct tax audit also, and the normal tax rates will be imposed on the assessee, that is 40% tax will be imposed on the assessee, and which all deduction will be allowed to the assessee. Let me show you. First of all, 3.2 crore is the income, is the revenue. Another 2 crore is the revenue. Against that, 28 lakh rupees expenses will be allowed. 21 lakh expense will also be allowed because these are expenses directly related to these incomes. Now, an expense which is not wholly and exclusively for Indian branch. If an expense is not wholly and exclusively incurred for the Indian branch, then that expense is not allowed under the income tax law. Okay, under 44DA it is not allowed. Plus, if any expense is paid to HO by the branch, if an Indian branch is making the payment to HO, then that is also not allowed. That is only allowed under one circumstance, if it is in the form of a reimbursement. But this is not a reimbursement. Because this is not a reimbursement, this will also not be allowed under the income tax law. 44AA assessee has to maintain books of accounts, and 44AB assessee has to conduct tax audit. The tax rates will be normal rates. I hope it is clear to all of you. The next question is a routine question of calculation of penalty. Nothing great as such. LLP is there. The return of income shows an income of 18 lakhs. But on processing the return under section 143 subsection 1, the income comes down to what? Comes up to 22 lakhs. Then while assessment, the income goes up to 35 lakhs. So how do you compute the underreported income? Underreported income is nothing but income assessed minus income processed. Therefore, 13 lakhs will become your underreported income. And then while computing the tax, will you compute tax on directly on 13 lakhs? No. First you will compute tax on 22 lakhs. First you will compute tax on 35 lakhs and then minus tax on 22 lakhs. Always do like that. And then you will impose 50% penalty because the question says that this is not on account of misreporting. Therefore, 50% penalty will be imposed on the assessee. Okay. Now, later on, even 147 assessment was done. At that time, the income was further raised to 42 lakhs. Now, how will you compute the underreported income? It is income reassessed, that is 42 lakhs, minus income previously assessed, that is 35 lakhs. Therefore, 7 lakh will be chargeable to tax in the hands of the assessee. Okay, that will be underreported income. Sorry, that underreported income, directly don't take tax, don't compute tax. Again, you will first compute tax on 42 lakhs. Whatever tax comes, 30% plus 4% cess, minus then you will compute tax on 35 lakhs. And then the differential amount will be tax on underreported income. On that, you will impose 5%. What? 5%. 50% penalty. That will be the penalty that the assessee has to pay under the income tax law. The third question over here, question number 9 over here is on MAT, minimum alternate tax. So here we have to compute the minimum alternate tax of the company. For that, we need to compute the book profit of the assessee. Okay. What is the question asking? Question is asking the minimum alternate tax under 115JB. What is the minimum alternate tax under 115JB? It is 15% of the book profit. So first of all, let us compute the book profit. The net profit as per PNL is 52 lakhs. Then provision for loss of subsidiary, add. Then provision for doubtful debts, add back. Then income tax, also add back. Next one, be very careful. Provision for gratuity based on actuarial valuation. This will not be added back. Why, sir? Because this is not unascertained. Only unascertained liability is added back to the MAT. The unascertained liability is added back. Provision for as per the actuary is not unascertained. It is actually ascertained. Therefore, this will not be added back. Depreciation you will add back. Yes, depreciation you will add back. And then other than revaluation, depreciation you will reduce. So how much is the revaluation? You can see other information. 80,000 is on account of revaluation. Therefore, out of 3,08,000, 80,000 is revaluation. Therefore, how much is other than revaluation? 2,28,000 would be called as other than revaluation. So add 3,08,000 minus 2,28,000. Okay. Next one, penalty interest. No, do not add. Interest you will not add back. Even if it is unpaid, it is added back under the normal provision, not under the MAT. Penalty is not added back under the MAT. Under the normal provision, it is added back if it is for infraction of law. But under the MAT, it is not added back. Next one, 10AA deduction. Do not reduce. Let it be part of MAT because on this book profit should be on this income, the tax has to be paid under the MAT. Okay. Do not reduce this. Then share of income from AOP BOI. Yes, on that MAT is not imposed. Therefore, reduce that because that is exempt under 86. Any income which is exempt under section 86 has to be reduced from the MAT. Be very careful. And long-term capital gains also, you will not reduce from the MAT. Let it be part of MAT only. Then whatever the MAT will come, whatever is the book profit will come, 15% book profit, then 4% cess, no surcharge because the book profit does not exceed 1 crore rupees. Now, the second question is, what would be your answer? If Ganga Limited is located in IFSC and derive its income solely in convertible foreign exchange, then the MAT rate will come to 9% only. It will be only 9%. And last, if an IFSC unit distributes dividend, then what will be the impact on the company and on the shareholders? I am an IFSC unit, I am giving dividend. What will be the impacts on the company? What will be the impact on the shareholder? It is fully exempt in the hands of both the person. Company don't have to pay tax. Even shareholders don't have to pay any kind of tax. Okay. I hope it is clear to all of you. Now, the next question is question number 10, which is based on what? Which is based again on exit tax. Now, there was a charitable trust which was set up in 2014. In 2016, it changed its object, and in 2016-17, it got the registration of the trust. Okay. So 2014 it was formed, 16 it changed the objects, and 16 and 17, it was what? It was registered as per the income tax law. Then in 2023, it got merged with a private company which is not eligible for what? 12AB. Therefore, exit tax has to be paid. Again, you have to compute all the assets and then all the liabilities. Then the difference between the two will be considered as what? As your accredited income. On that 34.944% you will take. Okay. First of all, land. For land, what you should take? You should take the stamp duty value or the market value, whichever is higher. But the Surat land, you are not going to take. Why? Because this land was purchased before the registration. Any asset which was purchased before the registration shall not be taken for the purpose of accredited income. Okay. Only assets which are purchased after registration are to be considered for accredited income. Same is for the liabilities also. This Baroda asset, yes, it is purchased after the registration. Therefore, stamp duty value or market value, whichever is higher. Therefore, market value is 105 lakhs that you have to take. For quoted shares, you will take the highest and the lowest price average. That comes to 265 rupees into 33,000 shares that you will take for the quoted share. For unquoted shares, preference shares, you will take the market value, that is 210 shares into 1800. And in liabilities, total liabilities 112 lakhs. Out of that, you will not take, you will reduce corpus fund don't take, then provision for tax also don't take, reduce all these things from 112 lakhs, okay? And reserves and surplus also reduce, whatever is the balance that you will take in the liability, reduce it from the asset, and then you will get the accredited income. Take the difference between the two, and that will complete your question 34.944%. So this is what your next RTP May 2021 is all about. I have taken over here only those questions which are not duplicated. Duplicated questions I have obviously removed from here because that will lead to what? Unnecessary wastage of time for you also and for me also, okay? So if there is any question which is repeating again and again, one time we have taken, subsequent time we have removed it. Okay, I hope it is clear. Just go through it and then we'll move ahead with the next RTP. So let's move on to the next RTP, that is RTP November 2021. Now this first question over here is a beautiful question. Pay absolute attention on this question. This is a question of two companies, X Limited and Y Limited. Let us talk about the two companies. Let us read about the two companies first of all. X Limited, an Indian company which is engaged in generation of electricity, and it was set up on 1/4/2018. And now this company has employed 500 new employees. All of them participate in recognized provident fund. Remember, if you want to claim deduction under 80JJAA, then you need to participate in the recognized provident fund. Okay. Now, out of that, all the payments are made by ECS. Yes, the payment also has to be made by account paycheck in case of an existing entity. In case of a new entity, it can be paid by cash also. Okay. Now, 18,000 per month for 150 employees, 22,000 per month for 150 employees, and 26,000 per month for the remaining 200 employees. Okay. Now, on 28th of September, the company has exercised the option for depreciating the assets at WDV method. As you all might be knowing that the assessee engaged in generation of electricity is eligible for SLM also, is eligible for WDV also. But if it follows WDV, then it can also claim what? It can also claim additional depreciation. If it follows SLM, then it cannot claim additional depreciation. Okay. Now, the turnover of 1819 and 1920 is 402 crore, 249 crore. And on 1/10/2020, it installed a new plant and machinery of 9 crore rupees and put the same to use immediately. Okay. Now, the company has received a dividend of 60 lakh rupees from other domestic companies, and it has distributed 72 lakh rupees to some other shareholders. Okay. Now, let's talk about Y Limited. Y Limited is also an Indian company. It is also set up on 1st of October 2020. It is engaged in printing of books. Now, it has also installed a plant and machinery and put to use. It has also employed 200 employees. They all participate in the recognized provident fund. Now, the gross total income of both the companies are 6.6 crore and 1 crore respectively, and they are subject to audit. Now, this gross total income is computed as per the special provisions under the Taxation Law Amendment Act. It means this gross total income is computed as per the alternative tax regime. This gross total income is not computed as per the normal regime. Okay. Now, it is computed as per the alternative tax regime. Now, we need to find out which alternative tax regime they have followed, 115BAA or BAB. Okay. Now, we need to compute the tax liability of X and Y as per the special provision. So, we need to identify in this question which special provision is applicable for them. Now, for the first company, the special provision which is applicable is 115BAA, because first of all, this company is not a manufacturing company. 115BAB is only for manufacturing company. Second reason why 115BAB is not applicable for this company is because this company is incorporated in 2018, and for 115BAB you should incorporate on or after 1st October 2019. Okay. So with that logic, this company will be eligible for 115BAA. Even this company will be eligible for 115BAA because 115BAB is not applicable for assessees engaged in printing of books. Printing assessees are not covered under 115BAB. So this assessee will also be covered under what? 115BAA only. I hope it is clear to all of you. Now listen carefully. The turnover, the GTI is 6 crore 60 lakhs and 1 crore rupees. Now remember, if an assessee is covered under 115BAA, then they are eligible for what? They are eligible for these chapter 6 deductions. ATM is allowed and even 80JJAA is allowed to the assessee. Let's talk about X now. Whether X will get 80JJAA? Yes. On 150 employees, 22,000 rupees is the emolument, so they will get 80JJAA. On remaining 150 employees, 18,000 is the emolument. On that also they will get ATJJAA. But on 200 employees where the emolument is 26,000 rupees per month, they are not going to get what? They are not going to get the ATJJAA because the emolument is greater than 25,000 rupees. What about ATM? Yes, even ATM is allowed under 115BAA. The company has received a dividend of 60 lakhs and has distributed a dividend of 72 lakhs on or before the date. So therefore, lower of the two will be allowed as deduction. Therefore, the assessee will get two deduction, 30% of this and 60 lakh rupees of this. And therefore, the tax liability will come to, total income will come to 3 crore 84 lakhs. And under 115BAA, the tax rate is flat 22%, flat 10% surcharge and flat 4% cess. And this will be the tax liability of X Limited. What about Y Limited? Y Limited gross total income is 1 crore rupees as per 115BAA. But Y Limited will not get the deduction of what? Deduction of 200 new employees because they are employed for less than 240 days. Because they are employed for less than 240 days, they will not be eligible for ATJJAA. ATJJAA is not allowed over here and ATM is not there in Y case. Okay. Now, the second one, compute the total income under the regular provision. How the income under the alternative regime will be different from the regular regime. In the regular regime, both the companies will get additional depreciation, which was not allowed under the alternative regime of 115BAA. So under the this regime, under the regular provision, both of them will get additional depreciation. How much additional depreciation? See, the first company has purchased a machinery of 9 crore and it is put to use on 1st October, and therefore it will be eligible for what? It will be eligible for full 20% additional depreciation. And the second company has also purchased and put to use on 1st October, and that company will also be eligible for full 20% depreciation on 2 crore rupees. Therefore, how this will be different? It is only different with respect to this particular point, that is here 9 crore 20%, here 2 crore 20% additional depreciation will be allowed to both the companies. Okay. Apart from that, everything else is same. Now, the third and the last question, suppose for X Limited, if they opt for special provision, then which would be better? Okay. If they opt for special provision inserted by, for this purpose, you may assume that the book profit of X computed under 115JB for AY 21-22, then which would be beneficial? Remember, if they opt for special provision, then their tax liability will be 96,64,510 rupees. And if they opt for special provision, then the provision of MAT is not applicable. But if they opt for the normal provision, then on this normal provision, they have to compute tax, and they also have to compute tax on the book profit, which is 4.2 crore, and then they have to compute whichever is higher, which will be applicable. If you opt for 115BAA, then MAT is not applicable. If you don't opt for 115BAA, then you also have to compute the MAT liability under the income tax law. Okay. Sir, under the normal provision, what would be the tax rate? The tax rate would be 30% because the turnover of the assessee of last year is greater than 400 crore. It is 402 crore. You can check it over here. I am circling, and therefore the turnover is greater than 400 crore. Therefore, in the current year, the tax rate will come to how much? It will come to 30%. Okay. I hope it is clear to all of you. This is how this question will be computed. It's a beautiful, beautiful question. Next question. There are 3 parts. Question number 12, in which we are supposed to answer with respect to trust. There is a trust which is registered as any other object of general public utility. Now remember, if a trust is registered as any other object of general public utility, then the commercial receipt should not be more than 20% of total receipts. Now the commercial receipt of this trust is 44 lakhs and the total receipts is 2 crore rupees, which is greater than 20%, which is exactly coming to 22%. Therefore, the trust will lose the exemption. It will not be eligible for exemption. Okay. Next one, a trust is paying a rent of 12 lakh rupees for 23-24 and rent of 15 lakh rupees for 24-25. And the TDS of both the rent is paid in the next year. The TDS of both the rent is paid in the next year. Therefore, what will happen? The TDS of first year, the rent of first year will be disallowed to the extent of 30%, and the rent of second year will be fully allowed because in the next year it is paid before the due date of filing of return. So both the year TDS is paid before the due date of the next year. Okay. So therefore, the current year rent will be disallowed to the extent of 30%, and it will be allowed in the next year to the extent of 30%. 30% of 12 lakhs comes to 3.6 lakhs. 3.6 lakhs will be allowed as deduction in the next year. What about this? Out of this 15 lakhs, you will be allowed only how much? You will be allowed out of this 15 lakhs, full 15 lakhs will be allowed because it is paid before the due date of the current year. Okay. I hope it is clear to all of you. And the third question is, a charitable trust was there. It has changed its object. Now we know that if a trust changes its object, and if the trust change its object, then it has to apply for a fresh registration within 30 days. But the trust unfortunately did not apply for the fresh registration. If the trust does not apply for the fresh registration, then it loses the charitable trust status. Therefore, the trust will be liable for what? Exit tax under 115TD at the rate of 34.944%. This is what this question is all about. The next question is about a Supreme Court judgment of a Bombay High Court judgment of Srimati Sunil Vishwambharanath Tiwari 2016. Now what has happened in this case? The assessee was eligible for deduction under ATIA and the claiming assessee was claiming a deduction of 18 lakh rupees. Now the AO has disallowed some 18 lakh rupees. Okay, so assessee is eligible for deduction under 80 IBA, and assessee was claiming deduction of 40 lakh rupees. Now the AO has disallowed some expenditure to the extent of 60 lakh rupees. Okay, 30% of that is TDS non-disallowances, TDS non-deduction. So assessee disallowed, AO disallowed what? 18 lakh rupees. So that 18 lakh rupees is also disallowed. So now the question is whether this 18 lakh rupees is also eligible for deduction under 80 IBA. So the Bombay High Court in the case of Sunil Vishwambarnath Tiwari has held that yes, this 18 lakh will also be eligible for what? Will also be eligible for deduction under 80 IBA. You have to give the deduction of entire 40 lakhs plus whatever is disallowed under PGBP. Therefore, entire 58 lakhs will be subject to what? Deduction as per this Bombay High Court judgment. I hope it is clear to all of you. The next question is on transfer pricing. Now, what exactly is there in the transfer pricing over here? First of all, to apply transfer pricing, we need to identify the relationship of associate enterprise, whether the two entities are associate enterprise or not, whether Delta and ALPS are associate enterprise or not. Yes, they are associate enterprise because one entity is giving loan to the other entity to the extent of 51% of the book value of the other entity. How, sir? See, the book value of the Delta is how much? Is 60,000 crore, and the loan is given to the extent of 350 crore euros. Because it is euros, you have to convert into rupees. So if I convert into rupees, it comes to 30,800. So the asset is 60,000 crore and the loan is 30,800 crore, which comes to definitely more than 51%, 51.33%. Therefore, both of them are deemed to be associate enterprise. Now the question is, when you are giving loan to your associate enterprise, you are charging how much? You are charging 9%. But when you are giving loan to other enterprises, you are charging only how much? You are charging only 7%. So there is a shortfall of 2%. So that much amount has to be what? Added to the income statement in the form of a primary adjustment. So this will answer the first two questions. The first question was examine whether transfer pricing provision would be attracted. The answer is yes. Both Delta and ALPS are deemed to be associate enterprise because of 51% relationship, and therefore that transaction is deemed to be associate enterprise. It is deemed to be international transaction, and therefore transfer pricing is applicable. Second question, whether primary adjustment will be made? Yes. On 30,800 crore, 2% is the shortfall of interest. Therefore, that 2% has to be added back to the income statement, which comes to 616 crore. That has to be added back to the income statement. Third, elaborate on the secondary adjustment if the primary adjustment is made suo motu by the assessee. Now remember, if the primary adjustment is made suo motu by the assessee, then the assessee has to bring back the money within 90 days from the due date of filing of return. If it does not bring back the money within 90 days from the due date of filing of return, then it has to consider this 616 crore rupees as deemed loan, and on that interest will be charged at the rate of LIBOR plus 3%. Why LIBOR? Because the transaction is denominated in foreign currency, therefore interest will be charged on LIBOR plus 3%. If the transaction would have been denominated in INR, then SBI MCLR plus 3.25% we would have taken. But here it is a foreign currency, therefore we are taking LIBOR plus 3%. Okay, is there any option available for me? Sir, what will be the period? Period will be including the 90 days interest will be charged. Interest will be charged from 1st of December only till 31st of March. Sir, is there any way I can just make some additional payment of tax? Yes, you can make a payment of tax of 18% tax, 12% surcharge, 4% cess. Once you pay that tax, after that interest will not be charged. But till the time you pay the tax, interest will be charged on you under the income tax law as per the concept of secondary adjustment. Okay. And one last question over here of this RTP. Pay attention, please. There is a non-resident, huge grant. A non-resident is there. It is providing some services to an Indian company, Himalaya Limited, and in return getting some getting some FTS, which is approved by central government. There is an agreement between both the party, and it is approved by central government. Therefore, now 115A and 44DA can apply. Okay. But the question says that the assessee does not have any fixed place of profession. If the assessee does not have any fixed place of profession, then the provisions of 115A will apply, and 115 says what? 20% or DTAA, whichever is lower. In first case, assume there is no DTAA, then the tax will be 20% as per 115A plus surcharge if applicable, and 4% cess. Assume that there is a DTAA and DTAA says that tax rate is 8%. If the DTAA says that the tax rate is 8%, then the tax will be charged at 8% only. It will not be charged as per 115A. And therefore, in this case, the assessee has to file the return also. Because if the TDS is deducted at a rate lower than 115A, then the assessee is supposed to file the income tax return also. In first case, there is no need to file the income tax return. In third case, the TDS rate is 20% because DTAA says 20%, 25%, and the income tax says that 20%. Therefore, TDS will be deducted as per 20% only. 20% will be charged plus cess will be charged plus surcharge if applicable will be charged under section 115A. Again, if the tax is deducted as per 115A, there is no need to file what? Any income tax return. Okay. And last but not least, if he has a fixed place of business, then to definitely 115A is not applicable, then 44DA is applicable. Under 44DA, he'll be chargeable with 40% tax, under not 40% tax because he is an individual, he'll be charged as per the slab rates. And under 44DA, he will be given the deduction of all the expenses, but certain expenses are not allowed. If an expense is incurred partly for Indian branch and partly for foreign branch, then it is not allowed. Only expenses which are wholly for Indian branch, that will be allowed. Plus, any payment made to HO will not be allowed, but reimbursement made to HO will be allowed under the income tax law. Plus, assessee is liable to do tax audit, assessee is liable to maintain books of accounts, assessee is liable to file the income tax return. These are the things that assessee has to follow. So, this is what this RTP is all about. So let's move on with the next RTP, that is RTP May 2022. The very first question over here is on slum sale. So there is a company Beta Limited which is transferring one of its units to another company, that is Delta Limited, and we need to find out the capital gains as per slum sale. So few things to be kept in mind. How a capital gains is computed in case of slum sale. You need to compute the FVC, and FVC is nothing but FMV1 and FMV2, whichever is higher. Then you need to compute the cost of acquisition. The cost of acquisition is nothing but the net worth of the undertaking. So we need to compute all those things one by one. So first of all, we will compute the FVC. In FVC, what is FMV1? FMV1 is the FMV of the assets which we are transferring, okay, as per rule 11 UAE. So what all assets we are transferring? The units of Omega, the fixed assets we are transferring, debtors we are transferring, and also we are transferring some liabilities, okay. So now be very careful. What is FMV1? FMV1 is A plus B plus C plus D minus L. Something like this is the formula, where A, B, C, D is asset, L is your liabilities. Now, for that purpose, let us see. In case of fixed asset, what is the first fixed asset? For FMV1, the land will be taken at what? Land will be taken at stamp duty value for the purpose of FMV1. Okay. Then what about the other assets? The other assets which represents plant and machinery, that will be taken at book value for the purpose of FMV1. In FMV1, we take book value for other assets. Okay. For land, we take the stamp duty value. And in case of debtors we are going to take the book value, that is 400 crores or 400 lakhs, whatever it is. For liabilities also we are going to take the book value as the FMV. You need to add all these assets and then you have to reduce the liability, you will get FMV1. What is FMV2? FMV2 is something which we have received. What we have received? We have received 600 lakhs as a consideration, that will become your FMV2. Now let us compute the cost of acquisition. Now for the purpose of cost of acquisition, the amounts will change slightly. For example, land, for the purpose of cost of acquisition, you will take the book value, okay. So for the purpose of cost of acquisition net worth, you will take the book value of land. Similarly, for the purpose of cost of acquisition net worth, for depreciable asset, that is plant and machinery, you are going to take the WDV as per the Income Tax Act. Which WDV? WDV as per the Income Tax Act. And for debtors, you are going to take the same book value, and for creditors also, you are going to take the same book value only, okay. So land value changes from FMV to cost, and even the plant and machinery value changes from FMV to cost. After that, you will compute your capital gains. The capital gains is long term because the unit was set up in 2010-11. I guess the unit was set up in 2010-11. Therefore, it is more than 36 months. Therefore, it is what? It is long term. Okay. And because it is long term, still you are not going to get what? The indexation under the income tax law. I hope it is clear to all of you. Okay. I hope it is clear to all of you. Now let's move on to the next question, that is question number 2, which is a very good question on manufacturing company, etc, etc, etc. It's a PGBP question on total income. Okay. Now pay attention, question number 17. First of all, assessee was incorporated in December 2021. The business was commenced in Jan 2022, and assessee is engaged in manufacturing and sale of certain tiles. Then the assessee is also following 115 BAB, where you have to follow the concessional tax rate. So you have to answer according to 115 BAB. Okay. Now the very first thing is the net profit of the assessee. The net profit of the assessee is 220 lakhs. The first adjustment is the assessee is buying some one-time license fee, and for that the assessee has debited that to P&L. Now it is wrong. One-time license fee cannot be debited to P&L. It is nothing but an intangible asset. So what is the treatment that you are supposed to give? You have to add back to your profit and then reduce 25% depreciation, intangible asset. Okay. Second one, you are making 32,000 payment in cash to a transporter. That is allowed under income tax law. To transporter, you can make to goods transporter, you can make the payment in cash up to how much? Up to 35,000 rupees. Okay. Now the third one is an intelligent adjustment. You are receiving some rent of 60,000 rupees per month. It means total will come to 7,20,000 rupees per annum. First thing, reduce from PGBP and show under IFOS. Okay. And then again, you are debiting some municipal tax to the P&L account. So add back that municipal tax. And when you go to your house property income, you're not going to get the deduction of all these municipal taxes. Why? Because the assessee is following 115 BAB, and in 115 BAB, you do not get any deduction for other incomes. Suppose if you are earning some rental income, in 115 BAB, rental income is directly taxable at 22%. You are not going to get what? The deduction of municipal tax also, standard deduction also will not be given to you, nor any deduction of interest will be given under 115 BAB. So you have to be very careful with this point. Next one, you are making some donation for scientific research. That is not allowed under 115 BAB. Not allowed under 115 BAB. Next one, you are making some payment to contractor. TDS is not deducted. So 30% will be disallowed under the income tax law. Next one, you are receiving some dividend. So reduce from PGBP, show under IFOS. Okay. And then you are selling that particular shares which was purchased in 2017 and it is sold in what? It is sold in 2024 for 280 rupees. The FMV of that share on 31st Jan 2018 is 110. Whenever the FMV of any particular share is given on 31st Jan 2018, it means grandfathering clause is applicable. 112A will be applicable in that case. So in that case, what will you do? There are two things which you have to do. First of all, whatever is the gain, it is credited to the books of account. So whatever is the gain as per the books of accounts, how much will be the gain as per the books of accounts? The cost is 100, the sale price is 280. Therefore, 180 rupees will be the gain as per books of accounts into 10,000 shares. That is 1,80,000 will be reduced from your PGBP income. Okay. Then while going to capital gains, you have to be very careful. You have to follow the grandfathering clause. Step 1, cost of acquisition. Step 2, lower of sale consideration compared with FMV on 31st Jan 2018. Then compare with step 1, whichever is higher, and that will become what? Long-term capital gains. Okay, be very careful. Next one, some additional information. As I've told you earlier also, whenever there is an additional information, it means it is not debited or credited to P&L account. Additional information contains what? The first additional information, depreciation as per income tax, reduce that. Okay. Second, you are purchasing some machinery on 15th of November. So claim normal depreciation on that. Additional depreciation will not be allowed because under 115 BAB it is not allowed. Okay. And last but not least, the SSC hiring some employees. First of all, 51 employees were hired on 1st April. Regular employees, 23,000 is the emolument. So you can claim 80 JJAA even under 115 BAB. SSC going for 115 BAB can also claim 80 JJAA. Now, second employee will not get because the emolument is greater than 25,000 rupees. In third case, it is not allowed because the emolument is again greater than 25,000 rupees. In fourth case, it is not allowed because the employees are hired for less than 240 days. From 1st September to 31st March, it is less than 240 days. Okay. Now we need to compute the tax. On house property income, 22% tax will be charged. On PGBP income, 15% tax will be charged. On capital gains income, 1,70,000, 112A, 1 lakh exempt, 70,000 will be charged at 10%. Another source income, 22% tax will be charged. Okay. And then 10% surcharge is always applicable in 115 BAB and 4% cess will be applicable. Okay. Now next question is a question on MAT with Ind AS. You need to be very careful with the provision of MAT with Ind AS. There is an Indian company who is following MAT with Ind AS. So we need to follow the MAT with Ind AS concept over here. Now what is the book profit? The book profit after making the adjustment is 97,54,000 rupees. Now there are some OCI items which are given to you. Other comprehensive items which are given to you that will not be classified to the statement of P&L account. So some items which will never be classified to the statement of P&L account, you need to adjust that in the book profit. Like for example, deferred cost of hedging. If it is never going to be classified to the P&L account, so you have to classify that right now. So if I classify that right now, I have to debit that right now. And if I debit that right now, I have to reduce 2.8 lakh rupees from here. Okay. Now changes in the value of fair equity, changes in the fair value of equity instrument. This is an exception. This should not be adjusted. This should be adjusted in the year of sale only. This should not be adjusted right now. It will be adjusted in the year of sale. Similarly, revaluation surplus of the assets. Again, it will not be adjusted now. It will be adjusted again in the year of sale only. Remember, there are 2-3 items which I told you, which will not be adjusted now. It will be adjusted in the year of sale. Out of that, 2 items are given over here. Okay. You can open that page of MAT with Ind AS and compare with what I am trying to say. Next, deferred gain, which is credited to P&L and which is credited to OCI and it will never be classified to P&L. It will never go to P&L. So add that. And last point also, add that. Okay. You need to add these 2 things. Apart from that, the SSC is also going bankrupt and SSC is going for insolvency and bankruptcy code. Remember, generally under MAT, you get either the deduction of loss or UID, whichever is lower as per books of accounts. But in some exceptional cases, like where you are bankrupt and you are going for what? You are making an application to insolvency and bankruptcy code, then you are allowed both the things. So here you can claim both the things. That is, you can claim the unabsorbed depreciation also of both the years and you can also claim the brought forward loss also of both the years as per the books of accounts. Okay. Now, one last thing is there in this question. There is some transition amount also, which is to the extent of 68 lakh rupees. What has to be done with transition amount? The transition amount has to be added to the book profit. in ratio of 1/5. That is 1/5 in 5 years, you have to add it to the book profit. So how will I add back? But in the transition amount, again there are some exceptions which you should not take in the transition amount. Like capital reserve shall not form part of transition amount. Similarly, adjustments claim relating to differences in foreign operations shall not form part of what? Transition amount. Okay. Now, after that you have to compute the book profit. Then they have also given you the normal provision income. The normal provision income tax comes to 12.8 lakhs, and then you have to compare whichever is higher, and then we need to compute the MAT credit if possible. Okay. This is what this question is all about. Next question is a simple question. There is an institution who is solely registered for educational purpose and solely for hospital purpose, and the gross receipt from both of them is 3 crores each. Therefore, the aggregate gross receipt is more than 5 crore rupees. 3 crore from hospital, 3 crore from education. Therefore, the aggregate gross receipt is more than 5 crore. Therefore, it has to obtain the approval from commissioner. The assessee is saying that there is no need to obtain any approval because my individual receipt is less than 5 crore rupees. We do not see the individual receipts. We see the aggregate receipts. Therefore, it will not be covered over here. Okay. Therefore, the assessee is liable for what? For making an application for an approval from commissioner. Second, the assessee wants to set off its excess application of last year in the current year. Not allowed. If you have made an excess application in the last year, there is a loss. If you wish to set off in the current year, it is not available for charitable trust. Third, the assessee has borrowed 40 lakh rupees and it has incurred some expenditure. Now, whenever you take a loan and incur an expenditure, it is not allowed as reduction. But in fact, it is allowed as reduction in the year in which the installment is first paid. Whenever the installment will be paid, whenever the loan will be repaid, in that year it will be allowed. So 5 lakh rupees which is repaid to SBI, that will be allowed as a deduction. Okay. Next one is the e-commerce operator section 194O. There is an e-commerce operator like Amazon. It is selling some goods through a seller, that is a resident seller of 84 lakh rupees. Okay. So Amazon is selling some goods through a seller of 84 lakh rupees. So Amazon should deduct TDS at the rate of 194O at the rate of 1%. But if the seller does not give a PAN or Aadhaar, then the Amazon will deduct TDS at the rate of 5%. So here the seller is not giving PAN and Aadhaar. Therefore, Amazon will deduct TDS at the rate of how much? At the rate of 5%. I hope it is clear to all of you. Okay. Now the next question is again a beautiful question on non-resident taxation. There is a foreign company, that is the company incorporated outside India, foreign company, and the poem is also outside India. Therefore, the assessee is non-resident. Now, the very first thing with the assessee is earning is technical know-how. The assessee is providing some services to MNO Limited, an Indian company, and earning some technical know-how. Okay. Now, the consideration is given by the Indian company in the form of debentures of 30 lakhs. So, the foreign company, the non-resident is providing me services. I am giving debentures of 30 lakhs. So, how much, at what rate this debenture, this FTS will be taxable? This FTS will not be covered in 115A. Why it will not be covered in 115A? Because there is no agreement between both of them which is approved by central government. If you want to cover FTS and royalty under 115A, there has to be an agreement between both of them and it should be approved by central government. And because there is no agreement, this will be taxable at 40%. Now, on these debentures, the foreign company will also earn interest. So, foreign company has earned an interest of 2,85,000 rupees. On that interest also, the foreign company will be liable to pay tax at the rate of 40%. Again, that interest will not be covered in 115A. It cannot be taxed at 20% because it is in Indian currency. The loan given by the foreign company is in Indian currency. It is not in foreign currency. Therefore, it will be chargeable also at 40%. Second one, GDR. You are earning some dividends from GDR. Remember, dividend from GDR is taxable at 10% under 115 AC. Then you are earning some dividend from Indian companies. Remember, dividend from Indian companies will be taxable at 20% under 115A. Now, the next one is also very, very important. The foreign company has received some royalty. Now, this royalty is approved by central government. There is an agreement. Therefore, this can come in 115A. But don't make a mistake of writing 12,56,470 as the income of the assessee. No, this amount is received by the assessee. Now, because this amount is received by the assessee, you have to gross it up. Because this is received. This is not income of the assessee. This is the receipt amount of the assessee. Now, what is received by an assessee? What is received by an assessee is always after TDS. Therefore, 12,56,470 is after 20.8 TDS, 20.8%, 20% tax plus 4% cess. That is, it is 79.2%. Therefore, 100 is how much? You have to make a backward calculation. Then, business income will be taxable at 40%. And then, long-term capital gains, there is a mistake made by ICI. In the income, they are writing 132. In the tax, they are writing 232. Remember, long-term capital gain on transfer of unlisted shares, the assessee has two options. Without indexation, then the tax will be 10%. And with tax will be, with indexation, With indexation, tax will be 20%. Without indexation, tax will be 10%. Whatever the assessee wants to take, assessee can take as an option over here to compute its tax. One last question in this RTP is on DTAA, which is a very simple question, nothing great I have to say. In DTAA questions, I cannot say anything great. If any unique kind of question comes, then I'll speak on that. Otherwise, it doesn't make any sense to waste time on DTAA question. Still, I will say once that this is a resident assessee, aged 52 years, he is earning some income from India. So this income will be added to the income statement. Then share of profit is exempt, so you will not add this, okay? Then agriculture income of $40,000 from country G. So this you will add also in the income statement, because if you earn from country G, then that is definitely taxable, okay? Then this loss is there. This loss you can set off against the income of what? Business in Pune. In country G, it is not allowed, but in India, it is definitely allowed, okay? Then dividend income from country M, 30,000, that you will add it back. Rental income, 52,000. Then rental income, out of rental income, you are also paying 6,000 rupees municipal tax. You can also claim 30% standard deduction from rental income. All those things are allowed. You are following old regime, be very careful. Then you can claim ATC, PPF, 1,50,000, and then you can claim 25,000 premium deduction under ATD. You will not get 28,000. You will get only 25,000 rupees deduction. 28,000 is not allowed. 28,000 will be allowed. Up to 50,000 is allowed to resident senior citizens, and for other than senior citizens, it is only 25,000 rupees. So after that, you have to compute the average rate in India, and then you have to compare with the average rate in foreign country. You need to find out the doubly taxed income, and then you need to take the relief under section 91. I hope it is clear to all of you. Nothing great as such. So let us go ahead with the next RTP, that is RTP November 2022. The very first question over here is on computation of total income of a partnership firm and tax payable by the partnership firm. Now, this is a question of partnership firm where we have to compute the tax payable as per the normal provision as well as the tax payable as per the alternate minimum tax, because the assessee is a partnership firm and it is a 3-star hotel claiming deduction under 35AD. So let us first of all compute the net profit of the assessee, and let us compute the PGBP income of the assessee. Okay, so the firm consists of two partners, equal partners. Net profit is 26 lakhs, therefore the profit is 26 lakhs. The very first thing is depreciation as per books of accounts, so you will add back the depreciation as per books of accounts. Then there is an interest at the rate of 15%, therefore 15% will not be allowed. Total interest is 50 lakhs, 3% has to be added back. Only 12% is allowed to a partnership firm as per 40B, therefore 10 lakhs will be added back. Further, you have made some payment of 6 lakhs to a resident without deduction of TDS, so 30% of that will be disallowed under the income tax law. Now, you have purchased some motor car of 7 lakh rupees and it is also capitalized in the books of accounts on the date of commencement of the business. Therefore, you can claim 7 lakh as a deduction under 35AD. Further, you have incurred 2 crore rupees capital expenditure, out of which 1.5 crore is land. Land will not be allowed. Therefore, out of 2 crore, only for 50 lakhs will be allowed as a deduction. Okay. Then further, you have also purchased some air condition for the purpose of your hotel of 3,20,000. That will also be allowed as a deduction under the income tax law. After doing all these things, you are going to get your profit, and then that profit, in fact, you are getting a loss. Then this loss will be adjusted against what? Against your another hotel of 4-star, because 35AD loss can set off only against what? Only against 35AD income. So you can set off this loss against your another hotel profit, and then you can pay tax on the differential amount. Okay. Now you will compute the tax as per normal provision at 30% plus 4% says that will be your tax. Okay. Now we need to compute the AMT also, because if a partnership firm claims 10AA, ATIA, ATIB, etc., or a partnership firm claims what? Claims 35AD, then the provisions of AMT will be applicable. To compute AMT, we need to compute the adjusted total income. What is adjusted total income? It is nothing but whatever is the total income, add all the deductions under 35AD, but then you have to compute the depreciation on all these items. We need to compute depreciation on all these items. So on motor car, you will claim 15% depreciation. On air condition, you will claim what? You will claim again 15% depreciation. But on this, on all the three things, you are going to claim 15% depreciation in all three of cases. Okay. So on building, you are going to claim what? 10% depreciation. Okay. Because this is how you compute the adjusted total income. That is, the deduction under 35AD will be added back, but the depreciation will be reduced. Now, whatever the adjusted total income comes, you will take 18.5% adjusted total income AMT, 4% cess, and then you will check with your normal tax, whichever is higher will be liable for tax, and the differential amount will be considered to be what? As your AMT credit. So it's a simple question, nothing great as such. It's an easy question. Now, coming to the next question, question number 24. Pay attention, please. It's a beautiful question now. Now, this question is also based on a manufacturing assessee, and the manufacturing assessee is also claiming deduction under section 115 BAA. And once an assessee claims deduction under 115BAA, once an assessee opts for 115BAA, then the turnover is of no use to determine the tax rate because the tax rate is directly 22%. Okay, we don't have to see the turnover to determine the tax rate. Now the very first thing is the net profit. Net profit is 9 crore 50 lakhs. The first thing is depreciation as per accounts, that will be added back. Then you are giving some donation to political party, that is not allowed under 115BAA. It is not allowed. 80 GGB is not allowed under 115BAA. Okay, then you are making some payment for research institution, then that is also not allowed. Scientific research deductions are not allowed under 115BAA. You are receiving some dividend from foreign company, reduce from PGBP and show under IFOS. Okay, then you are also earning some long-term capital gains on sale of equity shares on which STT is paid, so reduce from capital gains. And while taxing it, if 1 lakh will be exempt under 112A, balance will be taxed at 10%. Okay, now the next adjustment is a good adjustment. You are purchasing some machinery. For that you have taken a loan of 4 crore 20 lakh rupees. 10% is the rate of interest. Now on 1st June 2023, you have taken the loan and the machinery is put to use. Machinery is put to use on 1st of Jan 2023. So for 7 months, the machinery was not put to use. So 7 months interest. 7 months interest will be what? Added to the cost of the asset. I hope it is clear to all of you. So what are you going to do? First of all, you will add back the entire interest. They have debited the entire interest to PNL. So entire interest comes to 10 months interest come to 35 lakhs that you will add back to the PNL. Okay. And then the 7 month interest, that is pre-acquisition interest, that will be added back to what? That will be added back to the cost of the asset. So be very careful. From 1st June to 31st March, the total interest comes to 35 lakhs. But from 1st June to 1st Jan interest, you will capitalize, and the next 2 months interest will be disallowed. Why it will be disallowed? Because it is paid on 1st of December after the due date of filing of return. It is disallowed. Always remember, what is disallowed is only revenue expenditure. What is disallowed is not capitalization of interest. Capitalization of interest to an asset is not disallowed because of non-payment. You have to capitalize to the asset whether you have paid or not. Yes, to claim it as a revenue expenditure, you have to do what? You have to make the payment on or before the due date of filing of return. Next, you are making some sale of plot of land to your 100% subsidiary. So, and the subsidiary is an Indian company, then that is exempt under section 47. So reduce from here and exempt under section 47. You have paid some foreign technician salary for installation of machinery. So add that to PGBP, and then you have to claim that depreciation on that particular asset also, because this is for installation of the machinery. Therefore, you can claim depreciation on that. Next one is the beautiful adjustment. 22 lakh rupees goods you have sold, out of which 12 lakhs you have written off. So now how much is receivable? 10 lakh is receivable. 22 lakh you have sold, 12 lakh is written off. So 10 lakh is receivable. But fortunately you received 11 lakh rupees and you credited the entire amount to the statement of P&L account. Okay. Now entire amount is credited to the statement of P&L account. Now already you have credited 22 lakh rupees P&L account. Okay. Listen carefully. 22 lakh rupees first you have credited, 12 lakh rupees you debited, you write off. So 10 lakh rupees is receivable. Now fortunately you received 1 lakh extra. Okay. You received 11 lakh rupees. Now you credited entire 11 lakh rupees to the P&L account. Now only 1 lakh will be extra, na? That 10 lakh is already included in this 22 lakh rupees. Why I will pay tax on again 11 lakh rupees? Therefore 10 lakh rupees should be reduced from your PGBP income. Okay, because that is already included in 22 lakh rupees. You have already paid tax on that 22 lakh rupees. Okay, so as simple as that. Next one is depreciation as per tax. You have to reduce it. On office building you will claim 5% depreciation because it is put to use for less than 180 days. Computer you will claim full 40% depreciation because it is put to use not 5%, 40%. That is wrong. Okay. And plant and machinery, 5 crore is the value of plant and machinery. 100 lakhs will be the value of foreign technician salary, and 24.5 lakhs will be coming to what? Will be coming to your pre-acquisition interest, which will be added to the cost of asset, and you will claim depreciation on that at the rate of 7.5% because it is put to use in Jan 2024. Okay. Now you are also declaring some dividend on of 12 lakh rupees, so you can claim that deduction under ATM. ATM is allowed under the income tax law. Okay. Under 115BAA also ATM is allowed. Now while computing the tax, long-term capital gains of 4 lakh minus 1 lakh, that is 3 lakh will be taxed at 10%, and remaining income will be taxable at 22% tax and 10% surcharge. I hope it is clear to all of you. And health and education says at the rate of 4%. Now let us move on to the next question, question number 25. It's a beautiful question. There is a person, Mr. Rajesh, who is a unit holder of PQR. What is PQR? PQR is an alternative investment fund and is also a unit holder of Shipra. What is Shipra? Shipra is a REIT. Okay. And in both the companies, in both the entities, he holds 10% shares, 10% units since 2021. Okay. And since 2021, in both the entity, he is holding 10% units. Okay. Now, GPL Limited does not exercise the option of 115BAA, and Shipra and PQR distribute 90% of its income to the unit holder. Now remember, in case of Shipra, which is REIT, in case of REIT, only that much income will be taxable in the hands of unit holder, which is actually distributed, and not the entire income. But in case of AIF, there is a concept of deemed credit. In case of AIF, even if 90% is distributed, 100% will be taxable in the hands of investor. So we need to find out which income is taxable in the hands of Mr. Rajesh. First of all, dividend. Dividend from REIT, dividend from SPV. Dividend from SPV is exempt in the hands of REIT, and in the hands of investor also it is exempt if the SPV has not opted for 115BAA. If the SPV would have opted for 115BAA, then the investor would have paid the tax. But in this case, SPV has not opted for 115BAA, therefore investor is not liable to pay tax on this particular 2 crore rupees. Okay. Next, interest from GPL. Yes, on this 3 crore rupees, investor will pay tax. On how much amount investor will pay tax? Investor will get 10% of that, because his share is only 10%. Out of that, only 90% is distributed. So 10% of 90% will be taxable in the hands of investor. Short-term capital gains, REIT will pay tax. REIT will pay tax on short-term capital gains. Okay. Now let's come to PQR AIF. In case of AIF, business income, AIF pay tax, investor is exempt from business income. Okay. Long-term capital loss will be attributed to Mr. Rajesh. Why it will be attributed to Mr. Rajesh? Because Mr. Rajesh is holding the unit for more than 12 months. If an investor is holding for the units for more than 12 months, then the other losses will be attributed to the investor. Go and check the provisions of an AIF. And this 52 lakh rupees will be taxable in the hands of Mr. Rajesh at the rate of 10%. 10% will be what? 10% will be taxable income, because that much is the investment of Mr. Rajesh. In case of AIF, you don't have to see how much is distributed. In case of AIF, you are supposed to see how much is earned by the AIF. Okay. Then after that, last thing, it is also said that compute tax as per 115BAC subsection 1A. So therefore, the total income of Mr. Rajesh come to 32,20,000. You will apply the slab rates as per the new regime, and then you will compute the tax. Okay. One more important thing, in the question they are asking tax payable. Whenever they are asking you compute tax liability, then compute tax and leave it. But if they are asking you tax payable, then you have to find out the tax payable by the assessee by reducing the TDS which is deducted by the respective person. So assessee's TDS is deducted at the rate of 10%, and the rate of 10% under 194 LBA and 194 LBB. How much, sir? On interest 10% TDS is deducted, and also on this particular 2,70,000 will come on this interest income, and this 5,20,000 will come on this interest income. In both the case, the Shipra and PQR would have deducted the TDS of the assessee. Therefore, you have to reduce the TDS and find out the net amount payable by the assessee. Okay. Now coming to the next question, which is a small question on, but an important question on TDS. The first question is, Mr. Devansh is there, who is an Indian citizen, he is staying in New York. Therefore, he is non-resident. Now he has come to India on a visit. And he has purchased a tour operator. He has purchased a tour through a tour operator. Okay. He has purchased an overseas tour package and program. So remember, generally, if you purchase an overseas tour package and program up to 7 lakh rupees from 1st October 2023, then it is subject to 5% TCS, and above 7 lakh, it is subject to 20% TCS. Okay. But, if a non-resident comes to India on a visit, and if he books a tour, then the provision of 2061G is not applicable to the non-resident. Be very careful. Okay. This is what this question is all about. Next question. XYZ was incorporated on 1/4/2023. It means XYZ is incorporated in the current year. Its turnover for the current year is 12 crore rupees. And it purchases the following goods. It means XYZ is not liable for 194Q, because the last year turnover of XYZ is 0. Therefore, 194Q is not applicable on XYZ. Okay. I hope it is clear to all of you. But, what is the turnover of the seller of the last year? The turnover of the seller of the last year is 11 crore rupees. Therefore, the seller will be liable for 2061H, that is TCS under 2061H on receipt basis. Remember, the TCS under 2061H is on receipt basis, is not on receipt or debit, whichever is earlier. It is on receipt basis. Therefore, on first 25 lakhs, TCS will not be collected, because it is less than 50 lakhs. On next 30 lakhs, yes, on 5 lakh rupees, TCS will be collected on 15th October. Why 15th October? 15th September is the date of purchase, date of sale, and 1 month after that, payment is made. Therefore, on receipt basis, TCS is collected. Therefore, receipt is done on after 1 month. Therefore, the TCS will also be collected after 1 month. And next, on 15th of December, the goods are sold, but the receipt is done on 15th of Jan. So, on 15th of Jan, on this 15 lakh rupees, 0.1% TCS will be collected by the seller. Okay. Buyer is not liable to deduct TDS in this section, because the buyer's last year turnover is less than 10 crore rupees because the buyer is incorporated in the current year only. Okay. Now, the next question number 27 is also a beautiful question. Mr. Ravi Prakash, he is a resident Indian, 52 years. He has gifted 30 lakh rupees to his wife, Mrs. Sudha. Now, what Mrs. Sudha did with this 50 lakh rupees? She purchased the car of 29 lakh 52,000 rupees, which includes certain charges like RTO charges, insurance charges, 25,000 rupees warranty, accessory. Now the question is, what is the ex-showroom price of this car? So remove all these extra charges, you will get the ex-showroom price of this car, which is 26 lakhs 24,710. Remember, if Mrs. Sudha has bought an ex-showroom car of 26 lakh 24,710, which is more than 10 lakh rupees, the dealer would have deducted TCS or not at the rate of 1% for selling the car. Therefore, approximately 26,247 rupees would have been the TCS, which would have been deducted in the name of Miss Sudha. Now, Miss Sudha is saying that I am furnishing my Aadhaar number to the dealer, and she is saying that I don't have any other income except some rental income of 25,000 rupees per month, and she is not required to file the return as her income does not exceed the basic exemption limit. It is wrong. Her income might not be exceeding the basic exemption limit. I agree to that. But Mrs. Sudha's TDS is deducted to the extent of 25,000 rupees or more. Remember, if any individual's TDS is deducted to the extent of 25,000 rupees or more, then in that case, he is liable to file the income tax return. So because of the TDS deduction, Mrs. Sudha is liable for what? Deduction of TDS. Liable for what? Filing of income tax return. I hope it is clear to all of you. Question number 28. Let us read this question, which is on dispute resolution committee. There is an assessee who has filed a return of income and declaring an income of 28 lakh rupees. And the assessment is done and AO has increased the income by 5 lakh rupees. How much the AO has increased the income? By 5 lakh rupees. Now, the assessee wants to file an application to DRC. There is no order of detention against assessee. There is no prosecution against assessee. There is just one penalty which is imposed under the income tax law under 271D. Can Mr. Vijay file an application before DRC? Remember, to file an application before DRC, your income to be declared in the ITR should not be greater than 50 lakhs. So that is not greater than 50 lakhs. Again, the variation by AO should not be greater than 10 lakhs. So that is also not greater than 10 lakhs. There should not be any order of detention. There should not be any prosecution under income tax. There can be a penalty. Penalty is okay. There is no harm in imposing penalty. So therefore, Mr. Vijay can file an application. Second, by when he should file an application? He should file an application within 1 month from the date of receipt of this order. So whenever this order is received, within 1 month. So within 1 month will come to 25th December. Now, if he is not aggrieved, if he is not happy with the order passed by DRC, can he file an appeal? Can he challenge the DRC's order? DRC's order is not appealable. And the last thing, would your answer be different if the assessment order of AO is based on the information received under DTAA with country X? Yes. If the AO has passed an order by receiving an information under DTAA from country X, then it is not possible for the assessee to go for DRC, because that is an also exclusion covered under 245 MA, which says that if the AO has passed an order by receiving an information under DTAA from foreign country, then the assessee cannot go for DRC. DRC doors are closed for the assessee. Now the next question is a beautiful question. You have to be very careful with this question. Beautiful question. There is an Indian company over here. There is a foreign company over here, which is an e-commerce operator. Okay. There is an Indian company. There is a foreign company, which is an e-commerce operator. So again, I am saying it's a beautiful question. There is an Indian company over here and there is a foreign company .inc, which is an e-commerce operator. Now the question over here is whether this e-commerce operator will be liable for equalization levy or not of section 165A, which is a 2020 equalization levy, whether equalization levy will be applicable in this case or not. So there are a lot of questions that we need to answer. The very first thing that we need to see over here, first of all, for applying the 2020 equalization levy, the turnover of that foreign company, of that e-commerce operator, should be at least 2 crore rupees. It should not be less than 2 crore rupees. Okay. Therefore, the turnover is at least 2 crore rupees. Secondly, that person has to be non-resident. Yes, that person is non-resident. Thirdly, that person should not have any branch. That person should not have any permanent establishment in India. Fourthly, and the most important point over here, the service which is given by that person to an Indian company, to a resident in India, should not be in the form of royalty. If it is in the form of royalty and FTS, then equalization levy is not applicable. That service should not be in the form of royalty and FTS. Now the question over here is, what kind of service he is giving? He is giving a service of what? Of some online web platform through which it provides end user computer software through an end user license agreement. So again, I am saying, if equalization levy is to apply to that e-commerce operator, that e-commerce operator turnover should be 2 crore, that e-commerce operator should be non-resident, that e-commerce operator should not have any PE in India, and that e-commerce operator should not provide services in the nature of royalty and FTS. Now the question is, he's providing end user license agreement. Now the Supreme Court in the case of Engineering Excellence Limited has said that if any person is providing services in the nature of end user license agreement, then that is not a royalty. And if that is not a royalty, then equalization levy can apply in this case. I hope it is clear to all of you. Because the services which are given by him is in the nature of end user license agreement, therefore it is not a royalty. And because it is not a royalty, then equalization levy may be applied over here. Therefore 2% of the entire turnover will be subject to equalization levy under section 165A over here. I hope it is clear to all of you. Remember the 4 points which I have told you over here. Next question is a routine question of DTAA. I am not wasting much time on DTAA questions. If there is some unique points in DTAA question, I will be repeating that. Otherwise, I am not wasting much time on what? DTAA questions at least here, please. Now the next question is based on OECD's most favored nation clause, MFN clause. Now what has happened over here? We are entering into a DTAA with one country, country X. Listen carefully, it's a very logical and common sense wala question. We are entering into DTAA with country X and we are saying that if any person of this country will come to India and earn dividend, then we'll charge the tax at how much? 15%. Okay? How much tax will charge? 15%. So we are entering into a DTAA with country X and we are saying that dividend will be taxed at 15%. Now this country is our DTAA member and it is also a member of what? Of OECD. That country X is also a member of OECD, okay? And there is an MFN clause applicable to this country. Now listen carefully. It's a very simple concept. We are entering into DTAA with country X and country X people are liable for what? 15% tax on dividend and country X is a member of OECD. Now, after a few months or after a few years, we are entering DTAA with country Y now. Now, with country Y, when we are entering DTAA now, at that time we are saying that at that country people, country Y people, that is the second country people will be liable for tax at the rate of 10%. And the second country is also an OECD country and we are also part of the OECD. Now listen carefully please. Now the first country people will be very angry. They will say that we have entered into DTAA with you first. Then also you are charging us 15% and the country with which you are entering DTAA later, you are charging 10% in that case. Here comes the most favored nation clause. The most favored nation clause says that if you enter into a DTAA with a particular country at a higher rate and later on if you enter into a DTAA with second country at a lower rate, then you have to apply the lower rate to the first country also, okay? So you have to apply the lower rate of 10% DTAA to the first country also, which you are applying to the second country. But the condition over here is when you are entering into a DTAA with second country, you already had entered into a DTAA and that particular first country is also already a member of what? Already a member of OECD. For example, when we enter the DTAA initially, at that time that member was not a member of OECD, right? When we entered the DTAA with the second country, after that he became the member of the OECD, then we will not provide the benefit of what? Most favored nation clause. This is what this RTP is all about. So let's move ahead with the next RTP, and the next RTP that we are taking up as of now is November 23 RTP. After this, we will take the May 23 RTP also. Okay. So the first question over here is assessee is a manufacturer and assessee wants to follow 115BAA. So you have to answer the question according to 115BAA. Okay. Now the very first adjustment over here is the assessee is supposed to pay some interest of 24 lakh rupees, but instead of paying that interest, the assessee is issuing 8% debenture to the party. So whether that will amount to actual payment, and the answer is no. Actual payment means actual payment. Only conversion of outstanding interest into a new loan or into a new security bond or any other financial security or into a new debenture does not amount to actual payment, and therefore this will be disallowed as per section 43B. Okay. Next one, the assessee assessment is done and therefore the assessee is raised. Assessee is asked to pay some demand of 5,80,000 rupees, in which there is a surcharge of 57,000 rupees, 50,700 and cess of 22,308. It doesn't matter. When we disallow the income tax, we disallow the tax also, we disallow the surcharge also, and we disallow the cess also. So everything will be disallowed under section 40 small a subclause 2. Okay. Next, the provision for payment of gratuity is 180 lakhs. Remember, always provision for payment of gratuity is disallowed, but if any gratuity is actually paid, that will be allowed as a deduction, and therefore 105 lakhs is actually paid, that will be allowed as a deduction, and the provision will be disallowed under 40A7. Next one, there are some directors in the company who are going for foreign travel for the purpose of business. So they have incurred some foreign expenses, some travel expenses. Whether that will be allowed as a deduction? Definitely the answer is yes, that will be allowed as a deduction because it is for business purpose. Next, you are purchasing 82,000 rupees raw material on 26 Jan and the payment is made in cash. It is disallowed under section 48(3). Don't make emotional excuses by saying that it is on 26 Jan, bank was closed. It doesn't matter. Even if the bank is closed, you have to make the payment by online only of more than 10,000 rupees. Next, you are making some payment to a Japanese company of online advertisement services, and that Japanese company does not have a P in India. Therefore, if the non-resident does not have a P in India, and if you make the payment of more than 1 lakh rupees to that non-resident for online advertisement, you are supposed to deduct and pay equalization levy. The SSC has not done that. Therefore, this 11 lakh will be disallowed under the income tax law. Next one, corporate social responsibility expenses are disallowed as per explanation 2 to section 37(1). Next one is a routine adjustment. You are selling some land to a wholly owned subsidiary, okay, and therefore that profit is credited to the P&L account. So you will reduce from P&L account, because if you sell something to your wholly owned subsidiary, then capital gain is exempt under section 47. So you will reduce from here, and then you will show as an exemption under section 47. Next one, donation to a scientific research association, not allowed under 115BAA. Under 115BAA, donation to scientific research is not allowed. It doesn't matter whether the payment is made in banking account or whether the payment is made in cash. It doesn't matter. Next, the company has paid an interim dividend of 65 lakh rupees, but the company has received a dividend of 36 lakh rupees. So first of all, I will tell you the effect of this dividend. You will reduce this 36 lakh rupees from PGBP and show under IFOS, and while claiming a deduction under ATM, you will get deduction of lower of the two. Only 36 lakhs will be allowed as deduction under ATM, and you also have to disallow this 65 lakhs to PGBP, because this 65 lakhs is also debited to PNL. Okay, so you have to disallow that 65 lakhs, and while claiming deduction under ATM, you will claim only 36, because it is whichever is lower. You have to compare the dividend distributed with your dividend earned. Okay, next one is the company is contributing some 60 lakh rupees to employees pension scheme, and the contribution is 15%. How much is allowed? If an employer contributes to employees pension scheme, ATC, CD, etc., then only 10% is allowed. Therefore, 5% you have to add back, and 5% amounts to how much? Amounts to 20 lakh rupees. Sir, where it is written? It is written in section 36, subsection 1, clause 4A. Next one, very big question it is. Depreciation, you will add back. Donation to political party, not allowed under 115BAA. Sir, ATM is allowed under 115BAA. Yes, ATM is allowed under 115BAA. Normal depreciation, yes, you can claim. Additional depreciation, not allowed. Brought forward UAD, yes. If the UAD is out of normal depreciation, then it is allowed under 115BAA. But if the UAD is out of additional depreciation, then that is also not allowed under 115BAA. After all this, you have to apply tax, that is 22% flat tax, 10% surcharge, and 4% cess. This is the tax that the company has to pay who has opted for 115BAA. Okay. Now the next question is on TDS. A beautiful question, TDS and TCS. There is a company by the name called as Delta Company, which was incorporated in 2013, and it has purchased some coal from Fee Limited, another company, for 75 lakh rupees. Okay. Now remember, if somebody sells coal, then that person should collect TCS under section 206C subsection 1, right? Seller of coal is liable to collect TCS under section 206 subsection 1. With that logic, Fee Limited should collect TCS. But if the buyer, that is Delta Limited, has given a declaration that I am using this particular coal for manufacturing or power generation, then the seller will not collect TCS. Therefore, in this question, 206C subsection 1, TCS is not applicable. But we need to check one more thing. If TCS is not applicable under 206C subsection 1, a CBCD circular says that if the seller is not liable to collect TCS because the buyer is giving declaration, then the buyer has to see whether 194Q is applicable for him or not. Then the buyer should deduct TDS. Now the 194Q is not applicable to the buyer. Why? Because the buyer is incorporated in the current year 2023-24. Therefore, the last year turnover of the buyer is 0. And because in 194Q it is very clearly written that 194Q is applicable only if your last year turnover is greater than, business turnover is greater than 10 crore rupees. Therefore, in this case also, Delta Limited is not liable to deduct TDS also. Last question over here. Would your answer change if Delta was incorporated in the last year and the last year turnover was exact 10 crore? Then also my answer would not change, because then also my last year turnover should not be 10 crore. It should be greater than 10 crore. If it is exact 10 crore, 194Q is not applicable. So it's a beautiful question, just so I see it. Okay. Seller will not collect TCS because the buyer is giving declaration. Buyer will also not deduct TDS because buyer's last year turnover is not exceeding 10 crore rupees. Next question is also a beautiful question of Sigma Limited. Sigma Limited is a car manufacturer. It is selling some car to car dealers. Now remember, if a car manufacturer sell cars to car dealers, then the provision of 206C1F is not applicable. CBDT has given a clarification in the form of FAQ that car manufacturer selling the cars to car dealer, 1F is not applicable. If 1F is not applicable, now we need to see some other aspects. Okay. Then now if 1F is not applicable, then we need to see 206C1H and 194Q. Now let's see what Sigma is selling to Epsilon. Sigma is selling 10 cars to Epsilon of rupees 12 lakhs each. Okay. Of rupees 12 lakhs each. Sigma is selling to Epsilon of rupees 12 lakhs each. Now whether Epsilon, who is a buyer, is liable to deduct TDS, Remember, Sigma is not supposed to collect the TCS, but is the buyer liable to deduct? Is the buyer liable to collect TCS or not? Is the buyer liable to collect deduct TDS or not? Let's see. Let's see whether the epsilon's last year turnover is greater than 10 crore or not. Yes, the epsilon's last year turnover is 14 crore. Therefore, epsilon will deduct TDS. If Sigma is not collecting TCS, forget it. Epsilon will deduct TDS on how much? On 120 lakhs minus 50 lakhs, that is on 70 lakhs. Epsilon will deduct TDS at the rate of how much? At the rate of 0.1%. I hope you are clear. So again, I am saying, when a manufacturer like Sigma sells car to car dealers, then 1F is not applicable. Okay, so in case of Epsilon, 1F is not applicable. But Epsilon is buying cars of more than 50 lakh rupees, so Epsilon will deduct TDS. Now let's talk about Sigma and Omega. Sigma is selling cars of 10 lakh rupees each to whom? To Omega. Whether Sigma will collect TDS under will collect TCS under 1F, Sigma will not collect TCS under 1F. 1F is not applicable because again it is a car dealer. Okay, they are selling to car dealer. 1F is not applicable. Now we need to see whether Omega is liable to deduct TDS under 1H. TDS under 194Q. So what is the turnover of Omega of last year? It is only 9 crore. Because the turnover of the buyer of the last year is only 9 crore, buyer is not liable to deduct TDS under 194Q. Now you need to again come to Sigma and see if buyer is not liable to deduct TDS under 194Q, whether Sigma is liable to deduct TDS, whether Sigma is liable to collect TCS in under section 206C1H, because here the value of car is what? Is not exceeding 10 lakh rupees. Therefore, Sigma will collect TCS under 206C1H at the rate of 1%. Again, I am saying in both the cases, Sigma will not collect TCS under 1F. 1F is not applicable because both of them are dealers. Okay. In case of Epsilon, Epsilon will deduct TDS. Why? Because between 194Q and 206C1H, you have to give preference to 194Q. Because Epsilon's last year turnover is greater than 10 crore, therefore Epsilon will deduct TDS. In case of Sigma and Omega, Omega is a buyer, Sigma is a seller. Sigma will not collect TCS under 1F because it is selling to dealer. Omega will not deduct TDS because Omega's last year turnover is less than 10 crore. Therefore, the liability will again go back to whom? Sigma, and Sigma is liable to collect the TCS. I hope it is clear to all of you. Now, the next question is based on a case law which I have already uploaded in the case law lecture. But again, I would like to say it's a Singapore Airlines judgment where the question was whether the TDS will be deducted on the normal commission, that is the standard commission, as well as on the supplementary commission. And the answer is yes. The 194H says that, the Supreme Court says that TDS will be deducted on both the commission. Standard commission is a percentage of some your ticket, and the supplementary commission is a difference of the price at which it is sold and the price which is fixed by the airline authority. Okay. So on both the commission, TDS will be deducted. This is what this case law wants to say. And obviously this case law I have also discussed in the case law lecture. You can go and check over there. Okay. The next question number 35. Is about updated return. There was an assessee, Mr. Ram, who gets his account audited under 44AB for filing his original return. And for original return, he has filed for AY 2021 on 28th December 2020, and he has declared an income of 12 lakhs rupees. And in case of AY 21-22, he has declared a loss of 5 lakh rupees. Okay. Now, he wants to file an updated return for the second year and declare an income of 7 lakh rupees. Can he do so? Now, for second year, what was the loss earlier? For second year, earlier he has declared a loss of 5 lakh rupees. Now he wants to declare a profit of 12 lakh rupees. Can he do so? Yes, he can. If there is a loss return and if you want to convert that into an income, then you can file an updated return. If there is a loss return and if you file an updated return also with a loss, then it is not allowed to file an updated return. If a loss is converted into an income, then you can file an updated return. Therefore, you can file an updated return. Second, what will be the time limit to complete an assessment? Now, this is an old question which is asked. Therefore, the time limits are also as per the old limits. For AY 2021, the time limit was 18 months on the end of relevant AY, and from AY 21-22, it was for AY 21. Now, remember, for AY 2021, you need to file a normal return. Okay. So, if you are filing a normal return, the time limit will also be as per normal provision, 18 months on the end of the relevant AY. For AY 21-22, you are filing an updated return. And for updated return, the time limit is also different. It is 9 months from the end of the financial year in which the updated return is furnished. Now that 9 months is also changed by Finance Act 2023 to 12 months. Now because it is an old question, so we are writing in the solution the old time limit only. But if the question comes for AY 24-25, then you have to say 12 months from the end of the financial year in which the return, that is updated return, was furnished by the assessee. I hope it is clear to all of you. Next question is a simple question. There was a search which was conducted on assessee and there was some undisclosed cash which was found. Now the question is, can assessee set off its UAD and loss against this undisclosed cash? And the answer is no. There is one section, section 79A, which clearly says that if any income is found in search and seizure or survey, then any loss or unabsorbed depreciation cannot be set off against such income. Okay, it has to be directly taxable. The next question is again on case law of SAP Labs India Private Limited. If you see the case law lecture, you will find out this question also in the case law lecture. Let me explain you the facts of the case, what is exactly happening over here. The question over here is whether the High Court has the power to determine the arm's length price in case of transfer pricing. Remember, determination of arm's length is generally a question of fact, and you might be knowing that High Court cannot entertain question of fact. High Court can only entertain question of law. The last fact finding authority is the tribunal, and therefore High Court cannot get into all these things. Therefore, the question over here is, can High Court interfere in determination of arm's length price? The matter went to the Supreme Court, and the Supreme Court said that yes, High Court can determine the arm's length price subject to some condition, and that is High Court. I am not saying High Court will start to compute the arm's length price. No. High Court will just check whether all the provisions of the income tax law are properly followed or not. High Court will check whether the arm's length price is determined as per section 92C and its rules or not. If it is not determined as per that, High Court can direct the AO to change the arm's length price also. Okay, I am not saying High Court will sit and change the arm's length price, or High Court will ask the questions on the facts. No. But High Court can definitely interpret the law and can say the assessee that you have not computed the arm's length price as per the law. I am interpreting law. How much is the arm's length price? I am not interested. But the way you have computed, that is not as per the law. That is something which High Court can definitely do. Okay. Now the next question is a DTAA. Very simple question. Nothing great as such. You have to compute the DTAA. I am not repeating again and again these kind of questions. Important points I am saying. There is a basic salary. You have to take 62,000 into 12. Then DA is there. After that, from the DA, you are going to take 50,000 standard deduction. Then some royalties there. Expenses from royalties there. Rental income is there. You can take standard deduction from there also. Dividend is there. Then there is some property which you have purchased on which you have paid 1% stamp duty. Now this is an important point that I would like to highlight. So stamp duty, if you pay to purchase a property, that is allowed as a deduction under 80C. Okay. And then you are paying some health insurance for yourself, 26,000. Your age is 45 years. Therefore, you will get 25,000 for yourself and 50,000 for your non-resident parent. So if you make payment for your non-resident parent, there also you are going to get only 25,000, not 50,000. If the parent would have been resident and senior citizen, then 50,000 would have been given to you. Okay. Therefore, your 25,000 and your parents 25,000, total will come to 50,000 rupees. Okay. Next one more thing which you need to keep it in mind, that is 80 QQB section is applicable over here for royalty on books. 3 lakh rupees deduction you are going to get under 80 QQB. Apart from this is a very routine question. Okay. Now question number 39, that is the last question of this RTP, which is a beautiful question. There is a foreign company, Aster Inc., which is in Canada, and it owns a digital platform. That is, it is an e-commerce operator and it sells some e-readers of different brands globally. Okay. Now we need to identify in this question whether equalization levy is applicable or not. If yes, of which year? Whether 2016 equalization levy is applicable or 2020 equalization levy is applicable in these two cases. First of all, there is a website, Aster Inc., through which people are selling their goods. There is a seller, ABC Limited, an Indian company engaged in designing, manufacturing and selling e-readers. Whether this seller who is selling the goods through what? Through an e-commerce operator of non-resident nature, that is of what? Of Aster Inc., whether the equalization levy will apply or not. Let me talk about 2016 equalization levy. 2016 equalization levy is not possible because 2016 equalization levy is only applicable for online advertisement. Whether 2020 equalization levy is applicable, that is also not applicable because there is one condition that if the seller who is selling the goods through the e-commerce operator is in Indian, if the seller has a P in India, then equalization levy is not applicable. Very minute point. If the seller has a permanent establishment in India, now this seller is an Indian company only, definitely it has a permanent establishment in India. Therefore, that seller will not be subject to what? Equalization levy. So in this case, equalization levy is not applicable. In the second case, yes, it is applicable. The seller is a non-resident and the seller does not have a P in India and they are selling some goods, that is e-readers in India. Again, 2016 equalization levy will not apply. Why it will not apply? Because this is not a case of online advertisement. 2016 equalization levy applies only in case of online advertisement. This is the case of sale of goods through an e-commerce operator. Therefore, 2020 equalization levy will apply. How much it is sold? First, it is sold to Indian customers. Yes, it is covered. Second, it is sold to what? Outside customers, but they are using IP address located in India. Yes, that is also covered. Now, how will you compute the total turnover? One more thing you need to keep it in mind, that Aster Inc. does not have a P in India. If Aster Inc. has a P in India, then also equalization levy is not applicable. Aster INC does not have a P in India is a very important line. One more thing we need to apply. Again, 2016 equalization levy is not applicable. Only 2020 equalization levy is applicable. For that purpose also we need to check the turnover of the Indian from India should be at least 2 crore rupees. Therefore, 2000 e-readers into 12,000 plus 1000 e-readers into $150 into 80 rupees per dollar. This comes to 3.6 crore rupees if you total it. Now, because it is greater than 2 crore rupees, 2020 equalization levy under 165A will be applicable at the rate of 2%. Apart from this, they are doing some more transactions also. ABC Limited, that is this company, an Indian company, is making a payment of 25,000 to Aster INC, who is a foreign company, who is a non-resident, who does not have a P for hosting advertisement. Whether equalization levy will apply in this case? Yes, equalization levy is applicable in this case, because the online advertisement is provided by a non-resident who does not have a P in India to a resident who is doing business, and the online advertisement payment is more than 1 lakh rupees. Therefore, 2016 equalization levy is applicable in this case. In second case, XYZ had paid 32 lakh rupees now to Aster INC. Whether in this case equalization levy of 2016 will apply? 2016 equalization levy cannot apply, because 2016 equalization levy is applicable if the person who is in India has to be resident, or if the person who is in India has to be non-resident with a P in India. Only if a resident is there in India and making payment of online advertisement, or if a non-resident having a P in India making a payment out of India for online advertisement, then only 2016 equalization levy is applicable. In this case, the ex-INC is non-resident, but it does not have a P in India. Therefore, 2016 equalization levy is not applicable. And where 2016 equalization levy is not applicable, there you have to apply 2020 equalization levy. First, always you have to check 16 implication. If 16 is not possible, then you have to go for 2020 equalization levy. So in second case, 2020 equalization levy will be applicable at the rate of 2%. I hope it is clear to all of you. And this is what this RTP is all about. So let's move on to the RTP May 2023, and in this RTP the first 15 questions are MCQ, which I have already discussed and put on YouTube. You can check in full English also. So I'm interested in explaining and revising the descriptive questions over here. First question is question number 16, which is a question which is based on Finance Act 2022 amendment. If you realize that this is an amendment, there is an amendment which came in Finance Act 2022 which says that if you have taken a loan from someone and if you are not able to explain the source of the loan in the hands of the lender, then it will be taxable in your hand in the form of cash credit. So in this case, a partnership firm has taken a loan from what? Its partner. Now it is the duty of the partnership firm to explain the nature and the source in the hands of the partner also. If the firm is not able to explain the nature and source in the hands of partner, then the firm will be liable for tax under section 115 BBE, and 115 BBE is liable for how much tax? 78% tax, and therefore the assessing officer is attracting 78% tax because the partnership firm is not able to explain the source in the hands of the partners, from where the partner has got the money to give the money to the firm. Okay, so this is what this first question is all about. Let's move on to the second question. Question number 17. This is also based on what? Finance Act 2022 amendment. Very important amendment. It is very clearly written in the provision of section 43B, which says that if you take a loan from a financial institution and if there is an outstanding interest, then that outstanding interest is not allowed as deduction unless and until you make the actual payment. Now, can I convert that outstanding interest into a new loan and take the deduction? The answer is no. Can I convert that outstanding interest into a debenture or any other security and take the deduction? The answer is no. This is the amendment which is made by Finance Act 2022. So in this question, the assessee is taking a loan from a financial institution and converting the outstanding interest into a new debenture. That will not be allowed as deduction unless and until it is actually paid to the bank or financial institution. It will not be allowed as deduction. Okay, so this is what this question is all about. Now question number 18 has 5 different parts, which says that you have to identify whether the assessee is liable to file the return or not. So let's see whether the assessee is liable to file the return or not. Mr. Albert is there. His age is 31 years and his total income is just 2 lakh rupees. So by default, he is not liable to file the return. But because his turnover of business is more than 60 lakh rupees, he is liable to file the return. Do you remember that there is a separate amendment made by Rule 12BA or something like that? A circular was introduced by CBDT. It is also given in our easy notes. You can go and check over there that if your business turnover is more than 60 lakhs, you are liable to file the return. So because of that, the assessee is liable to file the return. Second, Mr. Aarish, age at 42 years. Now he is liable to file the return by default because his PGBP income is 2.5 lakhs and his interest income is 4,50,000 rupees. So his gross total income is 7 lakh, and any person whose gross total income is 7 lakhs is liable to file the income tax return. Now the third and fourth case is also very simple. Third case, there is a partnership firm, and in fourth case, there is an XYZ private limited company. And we all know that for a partnership firm and for a company, it is always mandatory to file the return irrespective of the total income. So these two assessees are liable to file the return. Now the fifth case is a very intelligent case. In this, there is a person, Mr. Valish, whose age is 58 years. He has deposited 50 lakhs in saving bank account. Do you remember that? If a person deposits 50 lakh rupees in saving bank account, then he is liable to file the return. If he is depositing 50 lakhs or more in the saving bank account, he is liable to file the return irrespective of whether his total income exceeds what?
exceeds 2,50,000 or not, it doesn't matter. Okay, so by that default, by that logic, he is liable to file the return. Is he liable to file the return under the normal provision? No, under the normal provision he is not liable to file the return because his total income is less than the basic exemption limit, but as per the special provision he is liable to file the return. Okay, now next question, question number 19 is based on search and seizure, and it is a very intelligent question. On 17th of April 2022, there is a search, okay, and the assessing officer found for 16-17 PY 23 lakh shares and for 17-18 PY 25 lakh shares. Now, for how many years he can send the notice? He can send the notice 3 years from the end of the relevant AY in normal cases. In special cases where the escaped income is 50 lakh rupees or more and it is represented in the form of assets like shares, land and building, advances, deposits, then it can issue notice up to 10 years. So now this does not come in the special case. Why? Because the total income which he has found does not exceed what? Does not exceed 50 lakhs. It is only 48 lakhs. Therefore, he cannot issue notice beyond 3 years. Now, what if this 23 lakhs is not 23 but it is 30 lakhs? This is part 2. If this 23 lakhs is 30 lakhs, then his escaped income will be more than 50 lakhs. Then in that case, he can issue notice even beyond 3 years. Okay, he can issue notice up to 10 years. Next, part 3 says that what if the AO has found that there was some expenditure of 52 lakhs incurred on the marriage of the daughter in previous year 16-17? Can he issue notice up to 10 years in that case? Yes. If there is an expenses or if there is an entry in the books of account, this is also a very latest amendment which was made in the last year only, that if there is an asset or if there is an expense or if there is an entry in the books of account, in either of the case, if it is of 50 lakhs or more, you can issue notice up to 10 years. This is what this question is all about. Okay. Now, next question is a very intelligent question and there are multiple parts in this question. If you go and see the solution, you will go mad that there are so many parts in this question. Question number 20. Now, let me give you a synopsis of this question. This question is on cooperative society, and cooperative society is engaged in marketing of agricultural produce grown by its member. Therefore, it is eligible for what? ATP. And a cooperative society which is engaged in the marketing of agricultural produce is eligible for ATP. Now, there are multiple provisions which we have to follow. First thing is there is a 10 new employees are employed by cooperative society of 20,000 salary, so they will be eligible for 80 JJAA deduction. Okay, now all the employees are paid by account paycheck, therefore they are eligible for 80 JJAA. There is no issue in that. Apart from that, the profit from agricultural income is 60 lakhs and the interest on fixed deposit is 32 lakhs. Now be very careful. They have asked us to compute tax as per the normal provision, as per 115 BAD also. They have told us to do everything. So the first possibility is compute tax as per normal provision, and if you are computing tax as per normal provision, you also have to compute AMT. When you compute tax as per normal provision, the first thing which you will take is PGBP 60 lakhs, and second thing is interest on fixed deposit 32 lakhs. And what deduction you will get? You will get deduction under 80 JJAA and you will get deduction under ATP of 60 lakh rupees. Compute tax as per the normal provision. Okay, and as per the normal provision, the slab rates you all know that up to 10,000 no tax, above 10,000 10%, then 20%, then 30%, so on and so forth. Okay, up to 10,000 10%, sorry, above 10% to above 10,000 20%, and above 20,000 it is 30%. Okay, now when you will compute the AMT, at the time of computing the AMT, you have to compute the adjusted total income. While computing the adjusted total income, you will add back 80 JJAA, but you will not add back ATP. Why? Because ATP is not liable for MAT. ATP incomes are not liable for MAT. Therefore, you will not add back ATP while computing AMT. One more thing to be kept in mind while computing AMT is now chargeable at 15% for cooperative society. By Finance Act 2022 amendment, cooperative society will be liable for AMT at how much rate? 15%. Be very careful. That is also an important issue over here. Okay. Next. Then you will compute tax as per 115 BAD. When you will compute tax as per 115 BAD, be very careful. You will not compute AMT because an assessee opting for 115 BAD are not liable for AMT. 115 BAD tax rate is 20%, 22%, 10% surcharge, 4% cess. Okay. Now, when you will compute tax as per what? 115 BAD. When you will compute income as per 115 BAD, in 115 BAD, you will get 80 JJAA, but ATP is not allowed. Only one chapter 6 deduction is allowed in 115 BAD, that is 80 JJAA. ATP is not allowed in 115 BAD. Now, the third possibility is we are supposed to assume that it is not an agricultural cooperative society, but it is a banking business. Suppose it is a banking business. That too, it is not an agricultural banking, not a primary agriculture credit society or primary cooperative. You are supposed to assume that it is not a banking company which is eligible for ATP. It is a normal banking company. So again, you have to make two computation. First as per normal provision and then AMT. When you will compute as per normal provision, you will take 80 JJAA. ATP is not now available only. Not available only. It is only available to primary credit society or for these kind of banking industries and not to others. Normal banking industries are not eligible for ATP. So compute normal computation. Take 60 lakhs, take 32 lakhs and take 80 JJAA. Do not take ATP. While computing AMT also, you will add back 80 JJAA. ATP is not there only. Anyways, it would have been then. Even then in AMT, we do not add ATP. ATP is not added back in AMT. Then compute your tax. Okay. Now, the fourth possibility, now assume it is 115 BAD. 115 BAD, when you will assume that, again you will add back only 80 JJAA because ATP is not there only, and you will compute 22% tax. And then you have to take a decision which is more beneficial. You can go through the solution. It's a very important question according to me. According to me, I say you can test on this question in your exam. Be very careful. Okay. Next question is based on 10AA There is a limited liability partnership LLP, and this LLP has two units. Unit 1 is SEZ unit, unit 2 is a domestic tariff area. Therefore, for unit 1 you will get deduction under 10AA. But while computing the tax liability, you have to compute the tax liability of the entire LLP. Now, therefore, the total income of LLP will be how much? Unit 1 has a profit of 710, unit 2 has a profit of 840. Now, you have to disallow certain expenses because those are not as per the income tax law. So, in unit 1, you have to disallow 41 lakhs, therefore profit will become 751, and in unit 2, you have to disallow 55 lakhs, therefore profit will become 840 plus 55. This will be your total income. So, what will be your total income? 710 plus 41, 840 plus 55. This will become your total income. After you are computed with your total income, what are you supposed to do? You are supposed to take deduction under 10AA, and 10AA deduction is available how much? Profit into export turnover divided by total turnover. Now, what is the profit of unit 1? Unit 1 profit is 710 plus 41, therefore unit 1 profit is 751. But from profit, you have to remove two things because those two things cannot be part of profit. That is, duty drawback cannot be part of profit, and profit on sale of import entitlement license. We have done all these things in 10AA. You can go and check. You are not eligible for these two things. Okay. Then you have to compute the export turnover. Export turnover includes only those turnover which has received in India in convertible foreign currency. How much is received? 1600 is received. Now, out of 1600, 180 rupees is what? 180 rupees is what? 180 rupees is with respect to what? Out of 1600, 180 rupees is with respect to insurance and freight, and therefore insurance and freight will not form part of what? Export turnover. So out of 1600, I am removing 180, therefore my export turnover is 1420. Similarly, my total turnover is how much? Export turnover is 1800, domestic turnover is 300, total turnover is 2100. Again, out of total turnover, you are not supposed to take what? You are not supposed to take freight and insurance. Therefore, freight and insurance in total turnover is how much? It is 300. So I am removing 300 from here. Therefore, my total turnover is 1800. If I multiply this, I will get my deduction as 525.4. I will take the deduction, I will compute tax at 30%, and then I will apply surcharge also if applicable, because surcharge is applicable according to me over here because the income is more than 1 crore. Now I will also compute AMT now. While computing the AMT, what am I supposed to do? I will add back 525.4 to get the adjusted total income, and then I will apply 18.5% plus surcharge if applicable and cess of 4%. Okay. So this is what this question is all about. Now next question is based on computation of total income and tax liability, that too as per 115BAA. We have to follow 115BAA over here, but in this is the manufacturer SSC, but in 115BAA, even if you are manufacturer, you are not going to get the benefit of what? Additional depreciation. So let's see one by one all the adjustments, assuming that we are supposed to do the question based on 115BAA, not as per the regular provisions of income tax. First thing is the income tax. The opening stock is overvalued by 10%. It means the opening stock is 110%. So divide by 110% and add back to the pre-P&L account. And the closing stock is undervalued by 10%. It means the closing stock is 90%. So divide by 90% and add back closing stock also. So adjust this in your net profit. Okay. Next is you are buying some intangible assets of 65 lakhs on 15th October. So you have to add back this intangible asset and you have to take 25% depreciation on that. That too you have to take what? 50% of that because it is used for less than 180 days. Intangible assets are subject to depreciation. They cannot be directly deducted from P&L account. Okay. So that's what I'm doing over here. Next one is 112A. You have purchased and shares for 85 rupees and then on 31st Jan the value of the shares is 195. This is the case of what? Listed shares. 112A will be applicable over here, long-term shares. And then when you are selling for 220. So you have to suppose to find out the grandfathering has to be applied over here. So first you will compare the FMV as on 31st Jan 2018 with selling price whichever is lower, and then you will compare with the actual cost whichever is higher, and therefore the cost will come to 195. The cost is 195, the sale consideration is 220, and if I compute the capital gains will come to 55,000. Now because the capital gains is less than 1 lakh rupees, it is not liable to tax because in 112A you get an exemption up to 1 lakh rupees. Okay. Next, electricity charges of February and March is not paid. It doesn't matter. Electricity charges are not covered in 43B. It will be allowed based on what? Accrual basis also. There is no need to make any payment. Next, there is an hedging loss on purchase of raw material. It will be allowed as a PGBP expense, and PGBP deduction will be allowed on that. Depreciation has to be added back as per books of account. Then dividend from foreign company has to be reduced from PGBP and show under IFOS. Then non-compete fees which you have received is a part of PGBP. Let it be part of PGBP. Non-compete fees is a PGBP income only. Next, you have forfeited some amount on sale of land, on negotiation of transfer of capital asset. You have forfeited some amount. Do you remember that? If the amount is forfeited after 1/4/2000 on or after 1/4/2014, then that is considered to be IFOS. So reduce from PGBP and show under IFOS. And if it is forfeited before 31st March 2014, then you have to reduce from the cost of acquisition. Now, in case of unlisted shares, I'll talk about that in a while. Next, you have purchased some machinery of 70 lakhs and you have put to use in the month of November. And there is also a loss of foreign currency on that machinery. That machinery is imported. So if there is an imported machinery, imported asset on which there is a foreign currency loss, that has to be adjusted in the block of asset as per section 43A. So 70 lakhs is the cost of machinery, 2 lakhs is the exchange loss, and therefore the cost will become 72 lakhs. On on that, you will take 50% depreciation, 7.5%, because the machinery is put to use in the month of November, and no additional depreciation will be allowed. Depreciation as per the normal provision will come to 35 lakhs. And then the next one is just an information. The next one is 80JJAA. Do you get 80JJAA in 115BAA? By default, you would have by hearted with this particular thing that in alternative tax regime, you get the benefit of 80JJAA. There are 59 employees, out of which 36 are employed from 1st June 2022 and at 15,000. So they will be eligible. But out of this 36 also, 10 employees are not eligible because their salary is paid by bearer check. If the salary is paid by bearer check, it is not eligible. Therefore, only 26 employees are eligible. The rest of the employees are not eligible. Either their emoluments is more than 25,000 or they are employed for less than 240 days. So only 26 employees are eligible out of 36 employees. Rest of the employees are not eligible only for the purpose of 80JJAA. Next, unlisted shares were acquired at 80 lakhs. Now be very careful. Unlisted shares are acquired at 80 lakhs and you have a profit on sale of 18 lakhs. Therefore, profit is 18 lakhs and purchase price is 80 lakhs. Therefore, the sale consideration will be 98 lakhs. Okay, this is how you have to compute. Backward, you have to go and compute the sale consideration, and then you have to index the cost of acquisition. The cost of acquisition is 80 lakhs. You have to index that, and that will be chargeable at 20% tax. Okay, and the rest of the income will be chargeable at 22% tax, plus all entire tax will be subject to 10% surcharge and 4% cess as per 115BAA. Next one is the same question which we have done earlier. You can go and check the chapter. Which chapter? Not chapter, one of the RTPs we have done in this session only. You can go and check that it is exactly the same question. I am not interested in doing this question again and again. You also don't do this question now for the second time before the day of exam, because it's a repetition of the entire provision. Okay, now the next question is question number 24. Question number 24 talks about what? The transfer pricing. There is a non-resident with whom we are doing some transaction. Okay, now that non-resident who gives us a guarantee of at least 12%. So if one entity gives a guarantee of loan of 10% or more, then both of them are deemed to be associate enterprise. Therefore, this transaction is what is deemed to be international transaction. Why? Because one of the entity is non-resident and the transaction is in the nature of purchase, sale, service, etc., etc., and that one entity is giving guarantee of 12% to the other entity. Therefore, both of them are deemed to be associated. Therefore, transfer pricing is applicable in this transaction. Now, the second part is saying that suppose if the primary adjustment of 310 lakhs is made by the assessing officer on 1/4/2022, then and the assessee has not repatriated that money till 31st March 2023, then what are the possible options that are there with the assessee? The first option is there, he has to pay interest. Secondary adjustment will be applicable, because if on 1st April 2022 AO is doing primary adjustment, assessee should have brought back that money within 90 days from 1st April 2022 in India. If he is not bringing that money, he will be chargeable for interest from 1st April only. For the entire year, interest will be charged at how much percentage? Because the transaction is in INR, SBI marginal cost of lending rate plus 3.5%. Therefore, the interest rate will come to 9 plus 3.5, that will come to 12.25%. Therefore, on 310 lakhs primary adjustment, you will be liable for 12.25% interest. Pay that. Second option is what? For the entire year, because the interest will be counted from the date of order and the order is passed on the very first day. The second option which you have is pay additional tax at the rate of 20.9664, that is 18% plus 12% surcharge, 4% cess, and you will be relieved from tax interest. You will be relieved from secondary adjustment from the date of payment of additional tax. Okay, and one last question is over here. This will complete all the RTP. This is based on what? DTAA question. Don't see that. That is a very simple question, a repetition of what we have done earlier in the previous paper. Now, a lot of things will repeat. Whatever will repeat, we are not going to do that. Neither I am going to do that, nor you are going to do that. Okay, it doesn't make sense to repeat the thing, because on the day of exam, we are short of time. Okay.
So now let us move ahead with our last RTP, that is RTP May 2024, and what is there exactly? The first question over here is of which is with respect to MCQ. So ignore this particular question. The RTP start from question number 14. So let us start this question. It's a very beautiful question. This is a question again on PGPP income, total income, but there are multiple things that we need to do over here. Let us read the last line of the question. We are supposed to compute total income and tax liability of the assessee in the most beneficial manner. So therefore, we are going to compute the multiple things over here. First of all, we are going to compute tax as per the normal provision. Then we will compute the tax as per MAT. Then whichever is higher will be applicable for the assessee. Then this is the first set of calculation. The second set of calculation that we are going to do in this particular question is, that is, we are going to, because it is asked to compute in the most beneficial manner. Therefore, the second time we are going to solve as per 115BAA. And when we solve as per 115BAA, we don't have to compute MAT liability at that time, because the assessee opting for 115BAA, they are not liable for MAT under the income tax law. The MAT is exempt for them. Okay, I hope it is clear to all of you. So now be very careful. Let us start with the question. First of all, we are solving as per the normal provision. That is not MAT, not 115BAA, a normal question. Okay, manufacturing assessee is there, 900 lakh is the profit. Therefore, that will be written in the statement. Then the assessee is making some payment for obtaining some know-how, so that is disallowed, and you will get 25% depreciation as a depreciation on intangible asset. Then there are some electricity charges which are not paid, so don't worry, electricity charges are allowed on accrual basis. It is not covered in 43B. Okay, next one, you are doing some hedging contract for import of raw material. and on which there is a loss. So you are doing some hedging contract on some trading item, that is raw material, on which there is a loss. So it's a trading loss. It shall be allowed as a business expense. Okay. So trading losses which are incidental to the business are allowed as a expense. It is allowed as a deduction, but capital losses are not allowed as a deduction. Next, depreciation which is charged to P&L, add back. Okay. The next one is a good adjustment. You are buying some imported machinery on which there is some foreign currency loss. So if there is an imported machinery and then there is a foreign currency loss, you have to add to the cost of the asset. Remember that as per section 43A. First of all, what you will do, you will add to the cost of asset. You will also add to PGBP income because that is debited to P&L. So add to PGBP income and then add to the cost of the machinery. The cost of the machinery is 65 lakhs and loss on foreign currency will be 2 lakh rupees. On this, you will get 50% depreciation because the asset is used for less than 180 days. The asset is put to use on 23rd in December 2023. Therefore, you will get normal depreciation and you will also get additional depreciation. But now, this is the only difference. You will get normal depreciation as well as additional depreciation. But when you follow 115BAA, you are not going to get the additional depreciation. That is the only difference between this calculation and 115BAA. Be very careful. Okay. Next, you are receiving some 20 lakh rupees for non-compete fees. So that is also a PGBP income. Let it be part of PGBP income. It is there in PGBP. Let it be part of PGBP. Next, you have received some advance in respect of sale of your property. So in respect of your sale of property, you have received some advance and the other person, that is the buyer, has not paid you the money, balance money. So you forfeited this 20 lakh rupees. So do you remember, if you forfeit any amount in case of negotiation of capital asset, in case of negotiation of transfer of capital asset, if you forfeit that on or after 1st April 2014, then it is income from other source. So reduce from PGBP and show under income from other source. I hope it is clear to all of you. Next one is, you are selling some unlisted shares and there is an excess of 15 lakh rupees. That excess is nothing but your accounting profit. You have to reduce that accounting profit from the PGBP and you have to compute the tax profit. The tax profit is how much? The cost is 80 lakhs and the excess is 15 lakhs. Therefore, the selling price will be 95 lakh rupees. On that, you will take indexation because unlisted shares become long term after 24 months. You purchase in March 2021 and you are selling in February 2024. So you are selling for more than 24 months old. Therefore, you have to take index cost of acquisition and this will be taxable at how much? 20% as per section 112. I hope it is clear to all of you. Then you will claim some additional information is given over here. Claim normal depreciation and claim 35 lakh rupees normal depreciation. And this is what this question is all about. Okay. Now you're going to compute the MAT liability. After that, you will compute the tax of the assessee. The tax of the assessee will be 25% tax because the turnover of last to last year is only how much? It is is only less than 400 crore rupees. It is up to 400 crore rupees. Therefore, the tax liability as per the normal provision will be 25% plus surcharge will be applicable if it is exceeding the income. I think so. If the income is exceeding 1 crore rupees, therefore surcharge will apply. Okay, and cess will apply. 405 crore rupees is of no use. You don't see the turnover of last year. You see the turnover of last to last year. Now, this is a normal provision tax. Now you will compute book profit. Book profit is fortunately directly given in the question as 1520 lakhs. So directly compute tax on that, 15% tax, and because the income is more than 10 crore rupees, 12% surcharge now and 4% cess. And then you take the MAT credit to the extent of the difference of the two. Okay, this is your tax calculation number 1. Now the second tax calculation, 115BAA. In 115BAA, nothing extra should be done. Only one thing has to be done is whatever is your total income as per the normal provision, add additional depreciation and you will get the income as per what? As per 115BAA. On that, apply 22% tax, apply 10% surcharge, apply 4% cess, and then check whichever is more beneficial. The tax as per the normal provision is more beneficial or the tax as per 115BAA is more beneficial. Whichever is more beneficial will be applicable to the assessee. I hope it is clear to all of you. Okay. The next question is based on some sale of mutual fund by the assessee. The assessee is a resident Indian, aged 55 years, and he wants to sell his entire mutual fund portfolio and he wants to buy some villa in what? In Lonavala. Okay. So he wants to buy some villa in Lonavala and he's planning to sell all his mutual funds. Now, there are 4 types of mutual funds which are there in front of us. You need to be very careful. BLR Growth Fund, ABC Strategic Fund, the third one is ABC Mid Cap Fund, and the fourth one is Growth Fund. Okay, SBA Growth Fund. Now, let me talk about all of them, what kind of fund it is. The first and the second fund are those funds in which we have invested 30% in the domestic company's equity shares. Therefore, 70% is in the dead. So only 30% is in the domestic companies of the equity share and therefore 70% is in the dead. Therefore, the first 2 funds are the dead mutual fund. And the next 2 funds have invested 70% in equity shares because it is written in the law. If you invest more than 65% in the equity shares, then only it becomes equity oriented mutual fund. Therefore, these 2 are equity oriented mutual fund. Now, we need to compute the tax. All of them are paying STT at the time of purchase and sale also. They are also giving us what? Some capital gains information over here, that is of CII, etc., cost inflation index. So remember, the first 2 funds are debt mutual fund, The next two funds are the equity mutual fund. Now let's talk about all of them one by one. First one is BLR Growth Fund. This is the debt mutual fund which was purchased in 2020 and it is sold in June 2023. So it is sold after 36 months. Therefore, this is long term, and if it is long term, you will also get indexation. So the new provision which has come 50AA, that is not applicable. The debt mutual fund will always be short term. No. That is applicable only if the mutual fund is issued on or after 1st April 2023. This mutual fund was issued on 3rd April 2020. Therefore, the new amendment is not applicable. So here, the mutual fund will be long term. The indexation will be available to the assessee. Okay. Second is purchased in May 2023 and sold in February 2024. Now, this is always deemed to be short term. Anyways, this is short term only. You are selling within 12 months. It is short term only. But anyways, even if it would have been long term, it would have been short term only, because here the new provision of section 50AA will apply over here. Be very careful. 50AA will apply over here, and 50 minus 46 will be directly your what? Capital gains, short term capital gains. Okay. So the first one is a long term capital gains. The second one is a short term capital gains. Now the third one, which is equity oriented, and the fourth is also equity oriented. The third is purchased in December 2022 and it is sold in July 2023. Therefore, it is short term capital gains and it will be covered in 111A tax at the rate of 15%. The fourth one is sold after 12 months, and the equity oriented mutual funds become long term after how many months? Equity oriented mutual fund becomes long term after 12 months, and therefore this is sold after 12 months, and therefore this is what? This is long term, and 112A will apply, and therefore because this is long term, there are out of the four funds, two are long term, two are short term. Okay, which one is long term? The last one is long term and the first one is long term, and against these two long term funds you will get the benefit of 54F. Okay, remember 54F is available only against long term funds. It is not available against short term capital gains. So where you sell all the long term assets except residential house property, and if you buy another residential house property within 2 years and construct within 3 years, then you will get an exemption. So you have to invest how much? Here there is one more catch which you need to keep it in mind. That is, you have to invest the entire consideration. Remember or not? Entire consideration has to be invested. Then only you will be having the advantage of this particular section. If you don't invest the entire consideration, then you will not have an advantage of this section. Therefore, let me talk about long-term SBA. Let me talk about this one. What is the gain over here? The gain over here is 10 lakh rupees. How you got 120 lakhs minus 100 lakhs, 110 lakhs? It is 10 lakhs. Okay. Now what is the consideration? How much you are investing? You are investing 1.2 crore rupees divided by what is the consideration? The consideration over here is 1.2 crore. Okay. Why I am taking 1.2 crore? I said, so we are investing how much? 2 crore. But we need to segregate that 2 crore into two assets now. So 120 lakhs we are segregating here, and remaining 80 lakhs we are segregating in the second asset. Okay. This is how we are going to proportionately take the exemption. Be very careful. What is the formula? The formula is gain into amount invested divided by net consideration. So in first case, I am taking the full amount, and in the second case, I am taking the balancing amount. I hope it is clear to all of you. Next question is a simple question. It's a theory question. That is, there is a commissioner of income tax who has issued some notice, to the assessing officer, and to the assessee that he wants to revise your order under section 263. Now, after sending the notice, after a few months he is sending another notice, and the content of the first notice is different from the content of the second notice. Okay, so remember, the CIT is sending a notice to you. Obviously in the notice he will send you on what reasons he is sending the notice, why he wants to revise your order, okay, which is prejudicial and erroneous by the assessing officer. So he's sending you notice. First notice he's sending you is writing all the details over there. Now after a few months he's sending another notice. The content of the second notice is different from the first notice. He's altogether changing the content. Therefore, is it allowed for him? It is not allowed for him. He cannot change the content like this in between. Okay, this is what this particular question wants to tell us. Now the next question is also a very beautiful question. These are all big questions. You have to be very careful with these questions. All beautiful questions are put in May 2024 RTP. So there is one person, Mr. Naksh, in whose case who is engaged in the export of fabrics, in whose case the CBDT there is a risk management strategy formulated by CBDT like SFT, AIS, etc., where the information is flagged for AY 2021, 21-22, 22-23 and 23-24. Now the AO wants to issue notice in April 2024. Remember, for how many years in case of Naksh, the AO wants to issue notice in 2024, and also is it necessary to provide him with an opportunity of being heard? All these questions are asked to us in case of Naksh. Now, the AO can send notice generally only up to 3 years. Now, in this case, 3 years is expired. For 2020-21, 3 years is expired. For 2020-21, 3 years will expire when? It will expire on 31st of March 2024, and the AO wants to issue notice after 31st March 2024. That is in April 2024. So for 2020-21, AO cannot issue the notice. What about AY 21-22? Yes, he can issue. For 22-23, yes, he can issue. For 23-24, yes, he can issue. He has time to send the notice in April 2024, if he wished to send a notice, he can send for 21, 22, 22, 23 and 23, 24. Now, is he supposed to conduct an inquiry? Yes. Some set of procedures have to be followed by the assessing officer. He need to conduct an inquiry under 148A. He need to give an opportunity of being heard to the assessee. Then AO will decide with an approval with higher authority that whether it is a fit case for assessment or not under 147. And then he will send a notice under section 148 for the assessee to file the income tax return. This is the entire procedure that the one has to follow over here. Now his friend is also there. In his friend's case, there is a search which is initiated. Dangerous point. In his friend's case, the AO has initiated some kind of search in April 2024. And AO has found some income pertaining to PY 2017-18 of 28 lakhs and 18-19 of what? Of 21 lakhs. So in case of his friend, can the AO issue notice? The AO cannot issue the notice. Why AO cannot issue the notice? Because 3 years have expired. For AY 17-18, that is AY 18-19, for PY 17-18, AY 18-19, the time limit will expire on 31st of March 2022. And for this, the time limit will expire on 31st of March 2023. For previous year 18-19, assessment year 19-20, the time limit will 3 years will expire on 31st March 2023. AO wishes to send in what? In April 2024, he cannot send that. Because he can send the notice beyond 3 years only if the escaped income is 50 lakh rupees or more. So he cannot send in this case. But the question says that, will your answer change? If that was 30 lakhs instead of 28 lakhs? Yes, if that is 30 lakhs instead of 28 lakhs, then the escaped income will come to how much? 51 lakhs. In that case, the escaped income is greater than 50 lakhs. Then for now, the AO wants to issue the notice. He can issue it. In this case, he can issue the notice. He has the power to issue the notice in such case, obviously beyond 3 years, up to 10 years, as the income escaped is 50 lakh rupees or more. I hope it is clear to all of you. Now, the next question is a beautiful question on a very new topic added by Institute in your new course, and that is your black money law. Mr. Rohit is there. He is an Indian citizen. He returned to India in March 2023 to work in an Indian company. Okay. And he served in the Indian company from April 2013 to 31st March 2020. Till that time, he was in India. Okay. Prior to 2013, he was in USA, and he again went to USA in 2020. So between 2013 to 2020, he was in India. Okay. And after 2020, he used to come to India only for 1 month every year. Okay. Now, he has acquired some wealth in India in different years. He has purchased some shares of listed company in 2012 and one apartment in London in 2015. One leather business is there from which he is earning some income in 2020. Okay. Apart from that, he is also taking some commission, etc. Now, the AO has issued notice under black money law to Mr. Rohit. Is the notice of the AO tenable for all these things? For this one item, second item, third item, and this commission, fourth item. For all these things, the AO has sent a notice to the assessee, and whether the notice is valid or not, that is what we are trying to say over here. Okay. Now listen carefully. You need to understand the provisions of the black money law. First of all, 30% income tax will be chargeable under the black money law. For 30% tax will be charged for undisclosed foreign income and assets. Okay. And in case of asset, the tax will be chargeable. In case of undisclosed foreign asset, remember, the tax will be chargeable in the year in which the AO notices such asset. Okay. So in whichever year the AO comes to know about that particular asset, in that year the AO will charge 30% tax on that particular asset. Okay. Now we need to understand the definition of assessee over here. The entire question is based on definition of assessee. Who is an assessee? An assessee means who is a resident. Any person who is a resident in the current year is an assessee. Okay. Or any person who is a non-resident in the current year. Listen, remember, if you are resident in 23-24, then you are an assessee. Or if you are a non-resident or not ordinary resident in previous year 23-24, but when you have purchased that property or when you have earned that income, in that year you were what? You were resident. Then also this section is applicable. Okay. This law is applicable. Today you are non-resident. Today you are not ordinary resident. But the year in which you have earned the income or the year in which you have purchased the asset, in that year you were resident. Therefore, we need to find out in the current year what is the status of Mr. Rohit. In the current year 23-24, Mr. Rohit is non-resident because he stays in India only for 1 month. In 2020, he has gone back to USA. Okay. So he is non-resident. Now, we need to understand in the year in which he has purchased the asset, in the years in which he has purchased the asset, what was the status of Mr. Rohit. So in the year 2012, that is in 2012-13, Mr. Rohit was non-resident. Therefore, this listed company share will not be subject to black money law. In the year 2015, Mr. Rohit was in India from 2013 to 2020. Therefore, this will be subject to black money law because he was resident in 2015. Third one, leather business is in April 2020. Now, he left in India in March 2020. He has left India, and therefore, because he left India in March 2020, therefore, in April 2020, he was not a resident in India. Therefore, he will not be liable to pay tax on this particular income. Okay, on this particular asset. As far as the commission is considered, the commission will be subject to tax, but only after previous year 1516 to 1920. Why, sir? Why not before 1516? Because the black money law was not applicable only before 1516. Black money law is applicable to income only if it is earned from 1516 or onwards. Black money law is not applicable to income earned before 1516. But for assets every time applicable. Even if in 1980 if you have purchased an asset, and in that year if you are resident and now you are non-resident, you will be liable for black money law in that particular asset. For asset there is no criteria of when the law was started. But for income there is a criteria of when the law was started. I hope it is clear to all of you. Now let's move on to the next question. It's a beautiful question of DTAA provision. It is not on unilateral relief. It is on bilateral relief, section 90. Okay. Mr. Mahesh is there, aged 50 years. He wants to follow the new regime. By default, everybody will follow new regime. Only 115 BSc is following. He's following the new regime. Accordingly, you need to answer. Okay. Now he's 50 years old. He's a CEO of a particular company, Silver Limited. Salary is 23 lakhs. You will take 50,000 standard deduction. Interest on self-occupied property not allowed in new regime. Be very careful. Not allowed in new regime. And then income from other source, interest from bank deposits, 1,60,000. That will go in IFOS. Now, foreign income, what is earning? Country A is earning some income. He's earning from business in country A, $25,000. So you need to convert that into rupees as per rule 115. You need to convert that as per rule 115. And for business income, you have to take TTBR on the last day of the financial year. And the TTBR on the last day of the financial year on 31st March 2025 is whatever it is, 31st March 2024, TTBR is 71 rupees. You have to convert as per that. Now, rent from house property is 4,500. From that, you will take municipal taxes deduction for 450 rupees, and then you will take 30% standard deduction also. In India, everything is allowed. Even if it is written, it is not allowed in country A. In country A, it might not be allowed, but in India, it is allowed. Okay. So you will take 4,500 minus 450 minus 30% standard deduction. Again, for house property, for converting that income into INR, you have to take TTBR on the last day of the financial year. Okay. Then comes the dividend income. For dividend income, whenever it is earned, you have to take TTBR on the last day of the preceding month. So it is earned in March. So now you will take not the last day of the financial year. For dividend, it is last day of the preceding month. Again, you have to see rule 115. Okay. So in March, if it is earned, you will take the last day of the preceding month. That is on 29th of Feb 2024. For short-term capital gains also $5,000. You will again see the last day of the preceding month. It was earned in March. So we will take TTBR on 29th of Feb 2024. After doing all these things, you will compute the total income in India and you will compute tax in India, and then you will take average rate in India. Okay. Average rate in India, and then you will apply that on doubly taxed income. How much is doubly taxed income in India? So you have to take this income, that is the rental income which you have computed as per rupees. Then you have to take dividend income which is as per rupees, and short-term capital gains income as per rupees. As per rupees, you are going to take whatever you have taken in the income statement. You have to take the total of that multiplied by whatever is the average rate. That is the DTAA rate. That is the average rate in India. Now you need to see the average rate in foreign country. The average rate in foreign country is 20%. And what is the income which is taxed in foreign country? The income which is taxed in foreign country is $4,500 directly. Now 450 rupees should not be reduced. Okay. So 4,500 directly, and then $10,000 directly, and then $5,000 directly. Take the total of that, and whatever total, and one more income is there, 25,000 directly. If you take the total of that, you will get 44,500. Now multiply that with what? 20% tax rate. And then you have to convert that issue into rupees. That FTC will be converted into rupees as per rule 128. Remember, to convert your foreign income into Indian income, you have to apply rule 115. But to convert your foreign tax into Indian tax while taking the FTC, you have to apply rule 128. And now for that, you need to see when the tax was paid. The tax was paid in May 2024. So as per rule 28, rule 128, you have to take TTBR as on 30th of April 2024. So be very careful. It's a beautiful question. When you compute the Indian tax, you will take the Indian rupees income. Okay. When you compute the foreign tax, when you will take all the foreign income, and then you will multiply by what? Rule 128. Whatever the rule 128 says, that is the TTBR on the preceding month in which the tax was paid. Tax was paid in May, so you will take the preceding month. Then whichever is lower, that will be allowed as an FTC to you. Okay. And the balance will be paid out of the pocket, or it might be 0 rupees. Okay. Now, one last question over here that will complete all the compilations that we are supposed to do with respect to the revision test papers. Okay. Pay attention, please, all of you. Question number 20, which is again a beautiful question on your advanced pricing agreement and rollback provision. The SSE is a company who is situated at Bangalore and exporting some goods and services, some electronic goods to its associate enterprise. Okay. Now, the SSE has made an application on 15th of Feb 2023 for advanced pricing agreement, which was signed on 5th of May 2023. And you might be knowing an advanced pricing agreement is generally signed for a period of 5 years. So now it will be applicable from previous year 23-24 onwards for 5 years. Okay. So previous year 23-24, 24-25 and 5 years like this. Okay. Now the SSE also wants to apply for the rollback provisions, and which was also signed in Jan 2024. Now the rollback years will be the last 4 years. Okay. Now the question which are asked as follows: we need to answer. Discuss the applicability of the rollback agreement for various assessment years. Can you go for rollback for all these years? That is what the question is all about. Now for AY 18-19, you cannot go for rollback because this comes beyond the 4 years period. Because in rollback, you can only roll back for past 4 years, okay, past consecutive 4 years. So AY 18-19 goes beyond 4 years. So you cannot roll back for that. For AY 19-20, that also goes beyond 4 years, okay. AY 18-19 is nothing but PY 19-20 is nothing but PY 18-19, and PY 18-19 is beyond 4 years. Again, you cannot go for rollback for this year also. Now what about AY 21-22? Yes, for this year rollback is possible, but sir, assessment is completed. It doesn't matter. Even if assessment is completed, there is no harm. You can go for rollback and AO will modify your assessment, okay. AO will change your assessment. What about 21-22, sir? This is a very good point. Pay attention, please. For 21-22, the assessment for 21-22 was completed by the AO by making a reference to the TPO, and TPO has enhanced the income by 500 lakhs. Suppose originally the income was, as per return, as per the assessee's return, the income was 100 lakhs. So the TPO increased the income by 500 lakhs. Therefore, it becomes 600 lakhs. Okay. Now the question is, if I go for arm's length price, if I go for advanced pricing agreement, that is rollback provision, now they are saying that it will come down to 300. So if it comes down to 300, will it be okay? The answer is yes. If it comes down to 300, then the total income will come to 400. The law says that the arm's length price can come down, but it shall not come down below the return income. It shall not come below the return income. So it is not coming below the return income. If it becomes from 500, it becomes 300. Then still it is more than return income only. Therefore, the rollback provision is possible for AY 21-22 also. Okay. So this is what this point wants to tell us. Next one is also a very intelligent point. For AY 22-23, the tribunal has passed an order for a fresh assessment by the assessing officer. See, the tribunal has not completed the assessment. The tribunal has passed the order. The law says what you know. If the order is passed by tribunal and it is concluded by the tribunal itself, tribunal has passed the order at itself and closed the matter, then you cannot go for rollback. Your tribunal has not closed the matter. The tribunal has referred the matter to whom? Or to the assessing officer for fresh assessment. I have told you all these things in the class. You can go and check in the class also. You have done all these things in your class. Okay. So therefore, in this case also, it is possible to go for rollback. In last case, it is impossible because you have filed the return late. One of the conditions to go for rollback is you should have filed the return on time of the rollback years. If the return was not filed for the rollback years on time, it is belated return, then rollback is not possible. Okay. So in this case, rollback is not possible under the income tax law. I hope it is clear to all of you. So this is what the compilation of 8 RTPs from November 2020 to May 2024 is all about. I have given my best for you all my dearest students of South India. It is very difficult, I am saying you again and again, to record this in 2 languages. That too, my month of Ramzan is going on. My fast is there for full 14 to 15 hours. I cannot drink even a single drop of water. Still, I tried my best. I committed that I will be doing this by 25th of April. But I think so I have did this on, I guess it will be uploaded on 6th of April or 7th of April, as the case may be by my technical team. So God bless you all. If you like this video, it is my sincere request as a Guru Dakshina from all of you that spread this video to all the friends in South India who wish to learn direct tax in English at the best of the quality that is possible across country. Only this is my request, okay? That share this video and recommend them to see this video. They will come to know what is the difference between this video and other videos available on YouTube, okay? So till then, take care all of you and comment what your views below and let me know by when do you wish to have the past paper compilation and the MTP compilation. You have to comment below and let me know, and you have to comment and tell me how did you find this particular video especially. Take care all of you. Bye.